Hello people, so now let's quickly revise capital structure topic, continuing in our marathon series. Now, previous topic में in the cost of capital, what was our objective? To find each source of capital का cost. In capital structure topic में, what is our objective is, which source of finance we should select the money. Now each source ka cost you know, cost of equity, cost of debt, everything you know. Now which source of finance you should select the money so that the overall cost of capital as in KO is minimum and value of the firm is maximum. From which source we should select the money? Should we select the money from equity, preference shares or debt? From what source the company should select the money so that the overall cost is KO is minimum and the value of the firm is maximum. That's the scope of this particular topic. Okay. Now again here also we need to remember a few formulas. One, value of the firm denoted by V or VF is given by the formula EBIT divided by overall cost of capital KO. Or another way to get value of the firm is S plus D. S means market value of equity. D means market value of debt. Usually finance manager will not prefer to issue preference shares. Why? They'll either go for equity option or debt option. Preference shares is not much preferred. Why? Because if you compare debt with preference shares, debt also you have to pay fixed interest. Preference shares also you have to pay fixed rate of dividend. But on debt we get one advantage or a benefit called tax benefit, which is not available in case of preference shares. Hence the finance manager would prefer to raise the money through debt rather than through preference shares. Hence the value of the firm is given denoted by the symbol S plus D. Preference shares are usually ignored in this. So these are the two formulas that predominantly we use over here. And one more one is, I've explained you the logic of all this in regular class. Now I'll not go into the logic. We'll just stick to the magic part. Okay. How do you get value of equity, sir? Using the same formula. Is EBIT available for equity shareholders or what is available? Each is available. So value of equity S is given by, instead of EBIT you will substitute with each or another name net income. KO you will substitute with cost of equity KE. So that if you do, you will get market value of equity denoted by the symbol S. So these are the three formulas that we predominantly use for the first set of problems. Okay, now can we do a thing? First we will run through everything theoretically and then we'll solve all the questions. Would that be okay with you? All right. Now people, in this particular chapter there are some theories. Some relevance theory, some irrelevance theory. Relevance theory ka argument is debt is important. Debt is, or door please, maybe. People who comes the last, make sure that your door is closed. Huh? Thank you, ma. Okay. So relevance theory ka argument is debt is important. By taking the debt, this particular theory argument is if company should take more and more debt, if you take more and more debt, value of the overall cost of capital will reduce and value of the firm will increase. Or maybe before I go into this theory, maybe one more I'll tell you. How do you get value of the firm, people? What is that formula? V is equal to EBIT divided by KO. Value of the firm is given by EBIT upon KO. Now people, this particular KO and value have inverse relationship, ulta relationship, meaning if KO increases, value will reduce. If KO reduces, value will increase. If you want, just check. Suppose KO is 10%, EBIT is 90,000. How do you get value of the firm? EBIT 90,000 divided by KO 10% means 0.1. So you will get 9 lakh. Okay. Suppose let's keep EBIT same, EBIT constant, value of the firm, let's make it to 12%. What is the answer till now? Instead of 10%, let's make it 12%. What is the answer you're getting? EBIT is still 90,000. Now KO is 12% means now you're getting 750. Check what happened. From KO, from 10 I made it to 12%. So KOV increase. KOV increase. What happened to the value of the firm? From 9 lakh it became 7.5 lakh. So that means the value of the firm reduce. Hence we say this KO and the value of the firm have inverse relationship. One increases, other will reduce. Okay, na sir? Now coming back to this theory, relevance theory ka argument is debt is important. By using the debt, KO we can reduce. What is this theory saying? By using the debt, overall cost of capital will reduce. And we just now learned if KO reduces, value of the firm will increase. That is the relevance theory ka argument. Sir, how will debt cause KO to reduce, sir? Sir, equity we have, debt we have. Which is a costlier source of finance? Which is a cheaper source of finance? Which is costly? KD is costlier, cost of equity is costlier. Sir, cost, for a company it's a cost, for the investor it's a return. Now, equity shareholders take more risk compared to the debenture holders, correct? Now, equity shareholders take more risk compared to the debenture holders, and risk and return go hand in hand. If you are taking more risk, you will expect more return. So, which is a more costly source of finance? Cost of equity will be greater than cost of debt. Debt is a rather a cheaper source of finance. All of you through with this. Now, people, this theoretical argument is, since debt is a cheaper source of finance, debt is a cheaper source of finance, more and more cheap source of finance if you take, overall cost will reduce. Overall cost as in KO will reduce, which will cause the value of the firm to increase. If you want, we can prove it with a small example. Let's say cost of equity is 15%, cost of debt is 10%. Weightage of equity is 90%, weightage of debt is 10%, 0.9, 0.1. Calculate KO for me. How do you calculate the KO? Take that instrument ka cost, multiply that instrument ka weight. These two you multiply, 13.5. These two you multiply, 1. What is the overall cost of capital you're getting? 14.5. Easy. Now let's assume company wants to take more debt. Company wants to more debt. Let's make it equal. Currently, what is the weightage? 90% equity, 10% debt. Now let's make it equal. 50-50. 50% equity, 50% debt. Check what happens. Cost of equity 15%. Now the weight is 0.5. Multiply these two. How much is it? 7.5. Cost of debt same 10%. But is the weight 0.1 now or 0.5? 50% we made. So these two, if you multiply, you will get 5. What is the KO now? 12.5. What did I do over here? Debt ka value we increased because company took more debt. What happened to KO? From 14.5 it became 12.5. So that's what this particular theoretical argument is. Since debt is a cheaper source of finance, more and more debt you use, overall cost of capital will reduce. If KO reduces, obviously value of the firm will increase. That is what relevance theoretical argument is. Understood, sir? Any problem? Now, under relevance theory, again, these are for 1 or 2 marks ka theoretical question. They don't directly ask you much. It's there. Quickly, 2 minutes we are running through. So, under relevance theory, we have two: net income approach, traditional approach. Net income ka approach ka argument is very simple. Same. Debt is a, compared to equity, debt is a costlier or cheaper source of finance. Compared to equity, debt is a cheaper source of finance. More and more debt you take, what will happen? Overall cost of capital will reduce and the value of the firm will increase. So that is what this theoretical argument is. So this theory assumption is KD and cost of equity. Cost of debt and cost of equity will be constant. Okay. You can take how much ever loan you want, whether you want to take 1 rupee loan or whether you want to take 100 crore loan. Cost of debt will remain same. That is this theoretical assumption. Practically outdated. Nobody will accept it. Taking 1 lakh loan and taking 100 crore loan same. 1 lakh loan, maybe you can take it at 10%. But 100 crore loan, bank may say, I will give it to you at 15%. If at all they say they will give or not. Yes or no? So obviously based on the amount, the cost of debt also will change. But this theoretical argument is both KD and KE will remain constant. Yes sir. This is about net income approach. Traditional approach ka argument is, traditional income is agreeing to one point. What is that it is agreeing is, compared to equity, debt is a cheaper source of finance. Compared to equity, debt is cheaper. But what traditional approach says is, debt will not be forever cheaper. Debt will not be forever cheaper. Debt will be cheap only up to a certain level. Debt will be cheap only up to a certain level. That means, let's say people, for my company level is 50 lakh. Let's assume for my company level is 50 lakh. That means up to 50 lakh, I can take the bank loan at a different rate or same rate. Same rate. Suppose I told a banker I need 10 crore loan. What is my limit? 50 lakh. Okay, I've already taken a loan of 50 lakh. Now I went to bank manager and saying, Kudra Machat, 10 koti loan. 10 crore loan. No? Yeah, I'm asking. Now you tell me, just because I took 50 lakh loan at 10%, will I be able to take 5 crore loan also at 10%? Will bank manager be comfortable? No, he may say, boss, I'll give you a loan, but not at 10, but I will give it to you at 12%. Possible? That is what this theory, traditional approach is saying. Debt no doubt is a cheaper source of finance, but debt is cheaper only up to a certain level, not forever, only up to a particular level. After that, check, initially I took the loan at 10, now I'm taking it at 12. So after that level is breached, cost of debt will increase. Okay. And taking debt is a risky affair, no? Taking debt is a risky affair. Why? Sir, if you take money from equity shareholder, if company takes money from equity shareholder, is there any obligation to pay dividend every year? Should the company pay equity dividend every year? No. Should the company repay the money back to equity shareholders? No. So there is no obligation to pay dividend. There is no obligation to repay principal. But imagine the same thing. If I take a bank loan, every month or every quarterly or every year I have to pay EMI. If I don't pay, what will happen? Can I tell banker no profit, no EMI? And they will say Tata bye. They will tell call the company assets and they will auction, sell. Yes or no? That means debt is a risky affair. Yes, no, people, correct. Huh? The moment company borrows too much of debt, the moment company borrows too much of debt, what happened to the risk of the company? Same or increase now? More and more debt company takes, the risk of the company will increase. If risk increases means will equity shareholders expect same return or higher return? So what traditional approach, the argument is up to a certain level only you borrow debt because it is cheap. Once the level is crossed, cost of debt also will increase. Cost of equity also will increase because business has become risky. If these two increases means your overall cost of capital also will increase, which will cause the value of the firm to reduce. So traditional approach is saying use debt carefully. Don't just borrow just because it is available. Use debt judiciously or carefully. That's all is this. Then Sarji. Again, not that very important for exam. Move on to the next. Okay. Next one, no? Next is irrelevance theory. Irrelevance means not relevant, like our classes. Absolutely not relevant. Okay, nah. So that is what irrelevance theory ka argument is. Debt is absolutely irrelevant to the value of the firm. What irrelevance theory is completely opposite they are saying. Whether the company takes debt or whether the company does not take debt, value of the firm will be same, unaffected or not affected. That is what this particular theory ka or irrelevance theory ka argument is. So by taking the debt, can the value of the firm be changed or no impact? No impact. That's what irrelevance theory ka argument is. Under irrelevance theory, the first theory is net operating income. So what is net operating income trying to say is, again, not very important. 1 or 2 points at best can come as theory. You may have to call it out. I'll spend 1 or 2 minutes and move on. Now what net operating income approach ka argument is? Sir, debt is a cheaper source of finance. Compared to equity, debt is a cheaper source of finance. If you take more and more cheap source of finance, what will happen to overall cost? Reduce. If KO reduces, value will increase. This is one part. Agreed? Now, irrelevant net operating income says not only this, one more thing will happen simultaneously. Along with this, one more thing will happen simultaneously. What is that? The moment company takes debt, business ka risk same or risk increases? The moment company takes debt, business becomes risky. The moment business becomes risky, equity shareholders will expect same return or higher return. So the moment you take debt, the cost of equity will increase because the business has become risky. If cost of equity increases, one cost increases means overall cost also will increase. And if KO increases, value will reduce. So this theory ka argument is these two will get netted off. Whatever value increase you saw over here, same thing will happen as value decrease over here and both will get set off. Both will get netted off. Hence the value of the firm, any increase, any decrease or same. See, that is what net operating income theory ka argument is. Done, Sarji? Yes, sir. So as per net operating income approach, KO, any change or no change? KO may check. First it will reduce, then it will increase by the same amount. Any change or no change? That means as per this theory, few things are constant. Read this and tell me, or you take a guess, what are the things constant? KO and the value of the firm will remain constant. Done, Sarji? What will keep changing? Cost of equity will keep changing because more and more debt you take, cost of equity will go on, increasing. So KE will change, but KD and KO will remain same. And even the value of the firm also will remain same. And EBIT also same. That is the argument of this particular theory. Okay, na sir? Now, under irrelevance theory, there is one more sir, sir. Modigliani-Miller approach or approach. Anybody remembers formula? Yeah, approach. Sir, sir is batting both for relevance and irrelevance theory. He's batting. He's on both the sides. He's a political party. One's left to one's right. Yeah, he'll keep jumping. So, sir ka argument is, if there is no tax rate, Habibi country, if you're operating in Dubai, no tax, no, right? If there is no tax in your country, then the value of the levered firm and unlevered firm will be same. Value of the levered and unlevered firm will be same, and both the firm ka KO also will be same. KO means overall cost of capital. Levered firm means what, people? Levered firm means that firm which has taken debt. Unlevered firm means that firm which has not taken debt. If a firm has taken any debt, means we call it as levered firm. If they have not taken debt, we call it as unlevered firm. If there is no tax rate, then both the firm ka KO and value will be same. If by chance tax exists, then by chance tax exists. Now, 1 minute. This is what, sir? Now you tell me, debtor, no debtor, value increase or value same? One firm has debt, one firm does not have debt. Both their value different or same? I mean, this under no tax, sir is arguing for which theory? Irrelevance theory. Whether you take debt, whether you don't take debt, value of the firm will be same. But by chance, if there is tax, by chance if tax exists. Now, what sir is saying is, on debt, we have to pay interest. On interest, we always get the tax benefit. Means, now you tell me, if there is tax rate, both the firm ka value can it be same? Unlevered firm has no debt. Levered firm has a debt. I mean, levered firm will get one extra advantage called tax benefit. So, if there is tax, sir is saying, value of the levered firm andre, that firm which has taken debt. Value of the levered firm will be equal to value of unlevered firm plus the tax benefit or tax advantage. Okay, now people. So, these two values are same or different? Different. I mean, now it comes under which theory? Under tax environment, sir is arguing for relevance theory. Done, sir? So, how do you get this tax advantage or tax benefit? Take the total debt and multiply by the tax rate. Take the total debt and multiply by the tax rate. Then you will get the tax advantage. Sir, you get tax benefit on interest, no, sir? Yeah. But you get interest you will pay only once year, only once throughout, or you will pay for every year? You'll pay every year. Hence, tax advantage or tax benefit is given by total debt multiplied by the tax rate. Any problem in this so far? All okay? That means sir is arguing both for relevance as well as irrelevance. Irrelevance comes under which approach? No tax scenario. Relevance comes under which scenario? Tax approach. Once again, call it out for me. If there is no tax rate, value of the levered firm, unlevered firm will be same. Both the firm ka KO, overall cost also will be same. But if there is tax, if tax exists, then value of the levered firm will be equal to value of the unlevered firm plus the tax benefit. And how do you calculate this tax benefit or tax advantage? Total debt multiplied by the tax rate. Okay. Now one more formula is quite important. Of late, we are seeing a lot of questions coming in exam using this. We have also done at least 5-6 questions using this particular formula. Once I will discuss this, considering it is important, I will do one more question now in the revision using this particular formula. Okay, here. Now, people, if they have given cost of equity of the unlevered firm, listen to this carefully. I know you should be able to remember in case you have forgotten. Once again, I'm calling it out. If you know cost of equity of the unlevered firm means we are denoting in the symbol KEUL. UL means unlevered firm. Again, unlevered firm means what, sir? Debtor, no debtor. If a company has not taken a debt, we call it as unlevered firm. So, there is a connection between what? Sir, if you know cost of equity of the unlevered firm, from that you can find cost of equity of the levered firm also. Levered firm ka cost of equity is denoted by the symbol KEG. Or if you don't like the symbol, you can write like this only. Cost of equity of the levered firm. Like that also you can present the equation. But this is the format they use. KEG means levered firm ka cost of equity. KEUL means cost of equity of the unlevered firm. Now, if you know cost of equity of the unlevered firm, you can also find out cost of equity of the levered firm, which is given by the formula First, take the cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. In fact, I have proved this formula to you in regular class. It's not really a formula. It is just a substitute. You know, WACC ka, right? It is just a substitute of that. I don't have time to prove that formula and all now. Okay, we have done it in regular class. For now, anyway, not our intention also. What will you do with proving the formula? They will not ask you to prove formula in the exam. What you need to only is remember the formula and solve. So let's focus more on the exam related things now than worrying about why of things. That's not the time anymore now. Oh, okay, tell me people once again, how do you get cost of equity of the levered firm? First, to take the cost of equity of the unlevered firm plus, open the bracket, cost of equity of the unlevered firm minus KD into debt into 1 minus tax rate divided by equity. D here is market value of debt, E here is market value of equity. And here people, KD is not cost of debt. Though formula says KD, here KD is not cost of debt, it is the interest rate. It is the interest rate. Okay. What is the difference? Tell me cost of debt ka shortcut method. Cost of debt ka one-liner method. Interest rate into 1 minus tax rate. Interest rate into 1 minus tax rate. So if you do interest rate into 1 minus tax rate, you're going to get KD. So this is not KD. Though the formula says KD, what is it here? Here, interest rate. Why here is, sir, on interest you get the tax benefit. We are already multiplying 1 minus tax rate over here. Again, if you multiply 1 minus tax rate over here, it will be double benefit. On one debt, you will get 2 times tax benefit or once. Since you have already multiplied 1 minus tax rate over here, again here we can't take 1 minus tax rate. Hence, we have to take interest rate. Agreed? So, everybody cool? This formula you will apply when tax exists. When there is no tax rate, tell me. This 1 minus tax rate will come or it will not come? Only cut off that. Rephrase that formula once again for me. How do you get cost of equity of the levered firm? Cost of equity of the unlevered firm plus, open the bracket, cost of equity of the unlevered firm minus KD. KD here means interest rate into debt divided by equity. Anyway, one tax rate is not there. Even if you multiply 1 minus tax rate anyway is 0. 1 minus 0 is what? 1. Even if you use this formula for no tax scenario, answer will be any which way? Same. Done, Ajay? This is important. Pay attention to this. We have seen a lot of questions on this coming in lately. Now, again, all these are approach, people. Whenever question says approach, remember, if you are stuck, some students find it difficult with respect to approach. When approach gets asked in the question, the trick will be, or the way to proceed will be 3 formulas. 1, if there is no tax rate, levered firm and unlevered firm ka value will be same. Their KO also will be same. That is 1. You should remind yourself of that. Second, when there is tax rate, value of the levered firm will be unlevered firm ka value plus the tax benefit. And how do you get tax benefit? Debt, total debt multiplied by tax rate. That is 1. Another one is this. These formula. These 3 may there will be solution. Okay, so if you are not able to proceed, at least try to put this formula and see where it goes. More or less the question will be solved. If you are stuck, I'm saying. Done. Now, going one step back again. Sir, if there is no tax rate, sir is arguing for irrelevant or relevant theory? Irrelevant theory. What is sir ka argument when there is no tax rate? Levered firm and unlevered firm ka market value should be same. Should be same when there is no tax. By chance, if it is not same. By chance, if it is not same. There is no tax rate. Market value of the levered firm, let's say, is 100 lakh. Market value of the unlevered firm is 95 lakh. These two should be different or same? As per sir, it should be same. Is it same or not same? If it is not same, then an investor, not a company, an investor can do something called arbitrage. An investor can do something called arbitrage. Arbitrage is a process which is done to get some gain. Arbitrage is a simple process it's an activity done to get some extra gain. Who does this? Company or investor? Investor. When you will do this? When these two firm ka value should be same. But is it same? No. When they are not same, then only you can do something called arbitrage. There are 4 scenarios of arbitrage we have done in regular class, 4 problems also, right? 1 I will take you through over here, another 3 orally we'll try to explain using that. Why not, people? This is a number game. Even if I tell now, it will not make sense. We will discuss that when the problem comes. Done now. But now you know the meaning of arbitrage. What is the meaning of arbitrage? If there is no tax rate, both ka value should be same. If it is not same, only if it is not same, then only an investor can do something called arbitrage. Arbitrage is simply some extra activity done by the investor to get some extra gain. Okay, so far this is good enough. All right, can I move on to the next one? Again, this is also not much. People in FM also 2 to 3 marks, you could say roughly around 3 to 4 marks also sometimes comes at theory level. Straightforward theory it is. So if you can try to, whatever I've called it on the chart book, at least that much of theory try to remember, it's better. Because if the theory comes, it will be pretty straightforward. And aram say you can do 2-3 marks, waha. You don't have to do anything, hardly it takes 1 minute to write it. Okay, rare, but 3-4 marks you can expect. Now, pecking order theory. Pecking order theory, what it says is, sir, different people in the organization have access to different set of information. Now, you are in ArivuPro Academy. I am also in ArivuPro. Both of us know same information about Arivu now. Both of us know same information about Arivu, or I will know little better information. I will know little better information. Yes, no. That is what pecking order theory says. Different people in the organization have access to different sets of information. At manager level, you will know something about organization. At director level, you will know little more. Yes, no. So that's what pecking order theory says. Now, as per pecking order theory, what this theory says is, you select money from that source of finance. You pick money from that source of finance which reveals maximum information, which gives maximum information. Whichever gives maximum information, prioritize and pick the money from that source. And as per pecking order theory, first priority, whenever company needs money, first priority should always be retained earnings. Next priority should be debt. Last priority should be given to equity. First priority, why do we give it to retained earnings is, sir, about retained earnings, is there any mystery left or we know everything? How do you get retained earnings? Whatever profit you have made, in the current year, from that you reduce all the dividend. Whatever remains only we call it as what? Retained earnings. Any more information you need to know about retained earnings, or you know full information? So which source is giving you maximum information? Retained earnings. After it, hence first priority to that. What is the next priority? Debt. Last priority what? Equity. Why does pecking order theory give last priority to equity? Is, sir, equity shareholders are risk takers. So they will expect same return, or their expectation will keep changing. In the good scenario, in the recession environment, they will expect less return, equity shareholder. When the things are good, they will expect a higher return. When COVID and all happened, people were be like, okay, let me get my money back from share market. Enough. But later when they started printing more money and Sensex went up, then everybody will like, I want 40% return. I want 100% return. Right now, so equity shareholder ka expectation will never be same. It will keep fluctuate. Yes, no. That means from this source, you will have full information and not so. You will not have much information because it is dependent on the market condition. And market condition, you cannot predict 100%. Hence, last priority to the equity as per pecking order theory. Done, Ajay? Okay, this is not important. Okay, this could be important. Financial break-even point. Or for class purpose, we used to call this as FBP. Financial break-even point means what is? Listen to this carefully. What should be EBIT? What should be the amount of EBIT so that EPS becomes 0? What should be your EBIT amount so that your EPS should become 0? For EPS to become 0, what should be EBIT? That's what financial break-even point is trying to calculate. Break-even point means no profit, no loss. No, correct? Financial break-even point means EPS should be 0. Operating break-even point means EBIT should be 0. In leverage, operating leverage uses operating break-even point. Here we are not talking about operating break-even point. You are talking about financial break-even point. Financial break-even point means what should be EBIT so that EPS should become 0. Done now. So in this financial break-even point, we have to find out EBIT. That's the crux of this question. Now people, when the company needs money, 3 sources of finance are usually preferred. What are those? Usually only 3. Equity. Equity here includes new equity shares and retained earnings. That is one source. Second, preference shares. Then debt. Now, financial break-even point for 100% equity plan. Meaning, company has raised the money only from one source. What is that? Equity. Equity here refers to equity share capital and retained earnings. if you're finding financial break-even point for 100% equity, then only if EBIT is 0, only if EBIT is 0, EPS also will become 0 under no other circumstance. I've taken 3 different examples, if you remember, in regular class, and I've proved it. We changed different numbers. Again, not important for the time being. So time being, you just need to remember the final answer. What is the final answer? If you want to get EPS 0 and if it's a 100% equity plan, what should be your EBIT? If EBIT is 0 means EPS also will be 0. If EBIT is even 100 rupees, EPS will not be 0, it will be something else. Okay, now this is for what sort of a plan? 100% equity plan. Next is not 100% debt plan. You can't have 100% debt plan. You could say more like here, this is equity plus debt plan. This is equity plus debt plan. If the company has raised the money as equity plus debt, for equity, what is financial break-even point? 0. But here only equity is there or even debt is there. Even if debt is also part of your capital structure, means then for EPS to become 0, EBIT should be exactly equal to interest charges. If interest charges is 10 lakh means EBIT also should be 10 lakh. Only then EPS will become 0. If interest charges is 5 lakh means EBIT exactly should be 5 lakh. Then only EPS will become 0. If EBIT and interest charges does not match means you will not get EPS as 0. You will get something different number. Again, we have proved all this. Now let's not go into that proving exercise. This is for what, people? What sort of a capital structure we are talking about here? Equity and debt. Last will be what? This will be equity and preference shares. This will be equity plus preference shares. So in this case, for you to get financial break-even point, EBIT should be equal to, okay, what was the debt ka financial break-even point? EBIT was equal to 5 interest charges. In the same grounds, if you build it up here, what should be the EBIT? EBIT should be equal to preference dividend. It is not EBIT equal to preference dividend. It is EBIT is equal to preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. Why is that? Sir, when will you pay preference dividend? Before paying tax or after paying tax? After paying tax. That means if you want to get EPS as 0 means 2 things company wants to recover. What are those? Tax also, preference dividend also. Only then EPS will become 0. That only is expressed as a shortcut formula as what? Preference dividend divided by 1 minus tax rate. Proving, no, now don't have to go into that. If you want the proving, I think video access is given to you. You can watch that. But exam time, what will you do with proving? Leave. Okay now people. So preference dividend divided by 1 minus tax rate. Suppose if you have all the three, Andhra, company has taken equity shares also, preference shares also, debt also. That means now add all the 3. What is equity ka EBIT? Financial break-even point 0. So ignore that. For debt ka interest charges. For preference shares ka preference dividend divided by 1 minus tax rate. So add these 2, that becomes your financial break-even point. So what is it? If all the 3 exist, if all the 3 exist, then financial break-even point is given with the formula interest charges plus preference dividend divided by 1 minus tax rate. This is rare. We don't usually see this much in exam. If at all they ask, you need to club this. Usually they will ask these separately. We'll solve one question also now on this. Done now? Clear. Can I move on to the next one, people? Next one is indifference point. Go one step back again. Previously, what was the concept? Financial break-even point. Financial break-even point means what are we trying to find here? We are trying to find EBIT so that EPS becomes 0. Indifference point means what should be EBIT? What should be the EBIT so that both the plans give same EPS? 0 EPS Allah. They give same EPS. 2 plans gives same EPS. Like here, let's say company needs 10 lakh money. How much money? 10 lakh money. Company has 2 options of raising that. Entire 10 lakh they can raise through equity. That is plan number 1. So plan or plan A. What is plan A? 100% equity. Any debt or no debt? No debt. Second plan, 50% debt, 50% equity. First plan is what? 100% equity. Second plan, 50% equity, 50% debt. I've just assumed this for explanation. A plan could be anything, right? So we have 1 plan here or 2 plans? 2 plans. What is indifference point trying to calculate us? what should be the EBIT so that both these plans give same EPS. Whether you go for plan A or whether you go for plan B, EPS will be same. Such level of EBIT only we call it as what, sir? Indifference point. That's the meaning of indifference point. It does not make a difference. Indifference is that only, no? It does not make a difference. And here also see, will it make a difference? Whether you go for plan A, in plan A, if you get 0.5, if you get 2 rupees as EPS, in plan B also you will get how much EPS? 2 rupees. That means whether company goes for plan A or plan B, EPS number any which way will be same. That's what indifference point is trying to calculate. Done now. That's given by fancy formula. Anybody remembers? Now what is that? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1 is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Okay, this was the thing. We are equating this. Why? So basically this formula is what? What is this numerator denominator? EPS ka formula. This is nothing but by doing this, what are you going to get? First plan ka EPS. In indifference point, mein first plan ka EPS and second point ka EPS will be different or it will be same? Same. Hence, first plan ka EPS we equate with second plan ka EPS. The same EPS. Now, what is the normal formula to get EPS, people? Normal way to calculate EPS. Each net income or each divided by number of equity shares. Earnings attributable to equity shareholders are also referred to as net income divided by total number of equity shares. If you do that, you will get EPS. This is that only. If you want, just check. So what do I want for my numerator check, people? What do I want? Now here, tell me. Or first maybe we'll take this. From EBIT, if you reduce interest, what are you going to get? EBT. Is EBT available for equity shareholder? No. First you have to pay tax. After paying tax, what are you left with? EAT. Is this available for equity shareholder or first you have to pay preference dividend? Deduct preference dividend. How much money remains? This number is this 53 is available for whom? Equity shareholder. This only we call it as EASH. EASH means earnings attributable or earnings available to equity shareholder. This number you take and divide by the number of equity shares and you get EPS. Correct? That's how you do it. Same thing we are getting. Now, what is this formula trying to calculate is? From here, it is trying to get here. From EBIT, it is trying to arrive at EASH. So, tell me now, what is the formula? From EBIT to get EASH, first what we have to do? First, you have to reduce interest. That's what is the formula. EBIT minus I1. I1 means we have one plan here or two plans. I1 means interest under plan number 1. Okay, sir. So, from EBIT, if you reduce interest, what are you going to get? Earnings before tax. From EBT, you have to reduce tax and get what? EAT. Now, from EBT, directly you can jump to EAT. From here, you can directly jump to EAT. How? Just simply, you do 1 minus tax rate. If you want, you do over here. What is EBT in this problem? 90. What is earnings after tax? 63. So, directly you do the jump approach. Take EBT and you do 1 minus tax rate. EBT is 90,000. Tax rate is 30%. 90,000 into 1 minus tax rate, if you do, what are you getting? 63,000. That's the reason in our formula we are multiplying 1 minus tax rate. Now tell me, what is this formula deducting? From EBIT, if you reduce interest, what are you going to get? Earnings before tax. From earnings before tax, if you do 1 minus tax rate, what are you going to get? Earnings after tax. We need earnings after tax or EASH. Hence also reduce what? Preference dividend. So by doing this, numerator is simply what? EASH. E1 is nothing but number of equity shares. We have one plan or two plan? We have two plans over here, no? So E1 means number of equity shares of the first plan. Done, sir. And now both the plan will have different EPS or same EPS? Same EPS. Now you tell me second plan ka EPS new formula. This alphabet wala formula. EBIT minus I1 na I2 now. EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. In this problem, every data will be given except EBIT. Solve this equation and then get EBIT. That will be your indifference point ka EBIT. That's all is this. Clear, sir? Now people, what is the synopsis of this? I've also proved you this also considering various numbers. If time is there, I'll also maybe once more prove it to you. Otherwise, I'll just tell you the synopsis. Sir, at indifference point, let's say you got indifference point EBIT is, let's say, 1 lakh or maybe okay. You solved this equation, no? You solved this equation and got how much EBIT? 1 lakh I assume. That is what people, indifference point ka EBIT. So at indifference point, which plan should I choose? Plan A na plan B, or it does not make a difference? At indifference point, what is my EBIT, sir? At indifference point, what is my EBIT? 1 lakh. So if my EBIT is 1 lakh, if my EBIT is 1 lakh, I can go for plan A or I can go for plan B. Doesn't matter, EPS will be same, because that is the very meaning of indifference point. At indifference point, both the plan will give you same EPS. That means which one can I choose? Anything. It will not make a difference. That's the first point. At indifference point, you can choose any plan, both the plan, any which way will give you same EPS. Okay. Now here I have assumed, carefully read this. What is the indifference point EBIT I have assumed? What is the indifference point ka EBIT I have assumed? 1 lakh. Okay, sir. This is the ideal number. If EBIT is 1 lakh, if EBIT is 1 lakh, you can go for plan A or you can go for plan B. Both will give you same EPS. Now, suppose people, you are doing a particular project. We are doing a particular project. Project will give us some return. No? That we are calling it as EBIT. Suppose we got a particular project ka, EBIT only 80,000. Only how much, sir? 80,000. Sir, what is this 1 lakh? Are you able to appreciate the difference between 1 lakh and 80? Tell me, what is the difference between 1 lakh and 80? 1 lakh is the ideal number. 1 lakh is the benchmark. Okay. Like 50% means CA pass. 50% means CA pass. That is the ideal number. You may cross 50. I don't want to say the other one. You may be little lesser than 50 also possible. So this 1 lakh is the ideal number or a benchmark. Okay, but an actual project ka EBIT can be 1 lakh. It can be more than 1 lakh or it can be less than 1 lakh also. Now, which scenario I have taken here? If because when you raise the money, for what joy will company take money? To do a project, no? And project will give you some return. So you did a project, and how much EBIT you are getting from that project? 80,000. What is the ideal number? 1 lakh. Now you got ideal number or lesser? So if project ka EBIT which is lesser than indifference point EBIT, what did I say? If a particular project ka EBIT, if it is lesser than indifference point ka EBIT, in that case you will always select that plan which uses higher equity. Below indifference point, you will always select that plan which is using more and more equity. Now you tell me, people, if project ka EBIT is 80,000, if project ka EBIT is 80,000, whether you will go for plan A, plan B, or it does not make a difference. If once again I'll give you the data. What is the data? Indifference point EBIT how much? Indifference point. What happened there? Indifference point EBIT is 1 lakh. But the actual EBIT, how much I have taken? 80,000. And now you tell me which one will you go for. First tell me once again the theory. Now, okay, or are you above indifference point now or are you below? Below. You are below 1 lakh. No, you did not achieve 1 lakh. We achieved only 80. So you are below indifference point. Below indifference point, what is the theory? You will always select that plan. Here we have one plan or two plan? Two plan. If you are below indifference point, then you will always select that plan which is using more equity. More equity, because that plan will give you higher EPS. I proved it to you in regular class with numbers. Now I will not prove. No time. Or we'll see. And now you tell me, theory I have told you. If this is the data, means whether you go for plan A or plan B. Plan A or plan B? Plan A. Why? Plan B is using only 50% equity. Plan A is using 100% equity. So which is using more equity? Plan A. So that means in this case, you will go for which plan? Plan A. So what the final answer is? You will select what? Select plan A. Done now. Now can we take the other scenario? Sir, what if the actual project ka EBIT is 1,50,000? Again tell me, what is the difference between 1 lakh and 150? 1 lakh is the benchmark, ideal number. 1 lakh is the ideal number. But a project, when you do a particular project, you may get an ideal number, or you may get lesser than ideal, or you may get more than ideal. That means now you are below indifference point or above. You are above indifference point. That's what is the next point. When you are above indifference point, you will always select that plan which is using higher debt. Above indifference point, you will always select that plan with a higher debt, because that one will give you a higher EPS. That's a theory. Once again, call it out for me. Which scenario? Above indifference point. Above indifference point, select that plan which is using more debt, because that plan will give you higher EPS. Theory. Okay, now you tell me, sir, if this scenario plays out, these two, you will go for plan A na plan B na. Indifference point is 1 lakh. Actual project ka EBIT is 150. Now you are below indifference point or above? If you are above indifference point, what is the theory? Select that plan which is using more debt, because that will give you higher EPS. First plan is using any debt or zero debt. Second plan is using some debt. So among these two, which is using more debt? Plan B. So what is the final answer over here? You will select what, sir? Select plan B, because by doing so, you will get higher EPS. Okay, na? If you want, you can assume random numbers and prove this, or refer the class video. I think one question we have done on this to prove this also. Maybe I'll see if we can possible. I'll try to do it now. Then, sir, that's your indifference point ka synopsis. Okay. Maybe I think one more we have. We'll discuss and we'll go for problems. Another one is small concept called overcapitalization, undercapitalization. Overcapitalization. Name only is saying overcapitalization. Overcapitalization means borrowing more than what is required. Suppose we need, let's say ArivuPro, we need 10 lakh rupees money. We want to open a new branch. How much money we need? 10 lakh. We borrowed 10 crore rupees. How much we need? 10 lakh. How much did we borrow? 10 crore. Sir, why, sir? We are crazy. So, okay, yeah, crazy. Yeah, that only. So, that scenario is what we refer to as what, sir? Overcapitalization. Meaning borrowing more than what is required. Now you tell me, if you need a 10 lakh, if you borrow 10 crore, can we utilize 10 crore fully or only keep it idle? Keep it idle. That scenario is what we call it as overcapitalization. Now tell me, what should be the remedy over here? If it's overcapitalization, should I keep the 10 crore or return back? That is what the remedy is. Okay. So basically, causes of overcapitalization is too much of borrowing at a higher rate. What is the remedy? Go for reorganization, meaning whatever extra money you have taken, give it back. Whether it's a debt or equity, return it back. Now, overcapitalization ka ulta is what? Undercapitalization. Now, people, let's say in this classroom, I can accommodate, let's say, 200 students. Let's assume. They're actually counting now. Okay. Let's say we can accommodate, or maybe, okay. We have gone with the example. We can accommodate how many students? 200 students. Sir, 500 people have called us for enquiry. Face to face. How many people? 500. But I have seats how much? 200. Got the scenario now. Ideally, this is a bad scenario for ArivuPro or good? Bad. If more people come, more money for us only, no? I can go on a better foreign trip. Correct, no? Right, if more students comes means for ArivuPro, bad or good only? Good only, no? Obviously, sir, we don't do charity, no? We collect money from you, no? Only marathon is free. Rest also you thought free, rest na free, kadiyadu pa. For rest we take money. Only marathon is free. Done now. Now, how many students are inquiring and want to join? 500. But how much can we accommodate? Ideally, if I'm a finance manager, what should I do? Maybe host 2 batches. Or maybe expand the classroom and try to accommodate 500. We told, meda, 200 only. We don't want to give coaching for 500 people. We want to coach only 200. Why? Again, crazy. Yeah. That scenario is what we call it as what, sir? Undercapitalization. There is a demand. There is a lot of demand. But are we fulfilling it or not fulfilling? So ideally, what we should do? We should take more money and do an expansion. Take another building on rent, or expand this classroom, or do morning, evening batch. Something we should do so that we can accommodate that particular demand. If you don't do that, it will lead to what case? Undercapitalization the scenario. Now, in undercapitalization scenario, that means people, now you tell me, demand is for 500 students, but we are fulfilling only 200. That means there is a good demand. So we will charge less fees or more fees. Lot of demand, no? You're already economic students. Yeah, if there is more demand, price will be increase. That means ArivuPro will offer the course at lower price or higher price. Higher price. Don't spread rumors. Just an example. So now ArivuPro, if we want, we can charge more price. That means we will earn less or we'll earn more. We'll earn more. But we have expansion plan or no expansion. That means what will I do with my earnings? Will I keep it or distribute to shareholders? Because if I have no plans to expand, what is the point in keeping it as a retained earnings? Because I have no plans to expand. So how much ever we earn, we will distribute dividend. So in undercapitalization scenario, dividend payout ratio will be on the lower side or higher side. Dividend payout ratio will be quite high. That is one you could say. 2-3 points you have to write when it comes as theory. In the chart only I have mentioned what and all you need to kind of remember and write. Now people, how much is the demand? How many students? 500. How much did we accommodate? 200. What about balance 300? They need coaching, no? Is ArivuPro giving? No. That means competitor will come. There is a lot of demand. We are not fulfilling it. So another academy will come. So that means in undercapitalization scenario, whose entry will happen? Competitor entry will happen. Okay, na Sarji? That's a simple meaning. Okay. Done. Again, not that very important. 2 points, in case it comes as a theory. Fine, sir. Except arbitrage, we have covered almost everything. Can we have a quick recap and then take up the questions? Few questions. Okay. Chapter name, what people? Maybe for your reference, I'll just show you the chart once again. Capital structure. What is the overall scope of this particular topic? Select that source of finance. Select that source of finance which will make the overall cost to be as minimum as possible. Where KO is minimum, which will cause the value of the firm to be maximum. That's our objective. KO should be minimum, value should be maximum. Choose source of finance, keeping that as a main objective. Okay. Next, here we learned a few formulas. So what is that first formula? Value of the firm V is given by EBIT divided by KO. One is that. Another way, value of the firm is given by S plus D. S for market value of equity. D for market value of debt. And S is for market value of equity. How do you get market value of equity? S. Can I take EBIT? Is EBIT for equity shareholder? What is available? Each. So in the numerator, you will take each. Denominator, KO or KE? KE. Yes, people? Alright. Now in this particular topic, we studied some relevance theory, irrelevance theory. Relevance theory ka argument is debt is important. By taking the debt, you can change your KO. Accordingly, your value of the firm also will change. So under relevance theory, first theory was net income approach. Net income approach ka funda was very straightforward. What is that? Since debt is a cheaper source of finance, use as much debt as possible. More and more cheap source of finance, if you take since debt is a cheaper source of finance, overall cost will reduce and value of the firm will increase. Because there is an inverse relationship between what and what. KO and value of the firm, there is inverse relationship. If KO increases, value will reduce. If KO reduces, value will increase. Like that. What about traditional approach? Traditional approach ka argument is what? It agrees that what? Debt is a cheaper source of finance. But will it be cheap forever or only up to a certain level? So use the debt only up to that level. Because after that level, cost of debt will increase. Cost of equity will increase, which will cause overall cost to increase and value to reduce. 1.2 in case if it comes as theory in exam. Okay, next is irrelevance theory. Under irrelevance theory, we had net operating income approach and MM approach. What is net operating income approach ka argument is? Debt is a cheaper source of finance. More debt you take, overall cost will reduce. If KO reduces, value will increase. This is one aspect. Along with this, one more will happen simultaneously. What is that? Since debt is a risky affair, the moment you take debt, business ka risk increase. If risk increases, cost of equity, expectation of equity shareholder will increase, which will cause overall cost to increase, which will cause value of the firm to reduce. This value increase and this value decrease will get offset and value of the firm will remain same. KO also will remain same. KD also will remain same. Only number which will keep fluctuating is cost of equity. That is as per this particular theory. Now next, MM approach. MM sir is batting both for relevance and irrelevance. That's based on the tax. If there is no tax rate, then MM sir is saying value of the levered firm and unlevered firm both will be same. Levered firm means that firm which has taken debt. Unlevered firm means which has not taken debt. If there is no tax, both the firm ka value will be same. If it is not same, an investor can do something called arbitrage to get some gain. If there is tax rate, then value of the levered firm will be equal to value of the unlevered firm plus the tax advantage. How do you get tax advantage? Total debt multiplied by the tax rate. This is one. Another one. Can you find out cost of equity of the levered firm if unlevered firm ka cost of equity is given? Yes. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus open the bracket cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. Though here we say KD, is this really KD or interest rate? Interest rate, because 1 minus tax rate is already multiplied here. If there is no tax rate, cut off this 1 minus tax rate, rest of the formula will remain same. Okay, next what? Pecking order theory. What does pecking order theory said? Different people have access to different level of information. Always select that source of finance which reveals maximum information. And as per pecking order theory, which source gives the maximum information? Retained earnings. So first priority for money should always be retained earnings. Then debt. Last to equity. Then financial break-even point. Financial break-even point means what should be the EBIT? What should be EBIT so that EPS becomes 0? So that depends on what kind of a plan. If it is 100% equity plan, then for EPS to become 0, EBIT also should be 0. If it is equity plus debt plan, EBIT should be equal to interest charges. If it is equity plus preference shares plan, then EBIT should be equal to preference dividend divided by 1 minus tax rate. If you have all the three, then financial break-even point means EBIT should be equal to interest charges plus preference dividend divided by 1 minus tax rate. Whatever number you get, that should be the EBIT. Only then EPS will become 0. Next to indifference point. Indifference point means whether you go for one plan or whether you go for second plan, EPS will be same. What should be the EBIT so that both the plan will give you same EPS? So indifference point is given by the formula EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. This is plan number 1 ka EPS equated with plan number 2 ka EPS. Expressed in alphabetical way, what's the formula? EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Okay. Alright. At indifference point, if project ka EBIT is exactly equal to indifference point ka EBIT, if project achieved exactly that level, then you can go for this plan or whether you go for that plan. Answer will be, or EPS will be same. At indifference point, you can select any plan, answer will be same. If you are below indifference point, if your actual project ka EBIT is lesser than indifference point ka EBIT, then you will always select that plan which uses higher equity because that plan will give you higher EPS. If your project ka EBIT, if it is greater than indifference point EBIT, meaning if you are above the indifference point, then you will always select that plan which uses higher debt because that will give you a higher EPS. Okay, undercapitalization, overcapitalization, chiller. Overcapitalization means borrowing more than what is required. Causes is too much borrowing. Remedy, repay. Undercapitalization, borrowing less than what is required. In these firms, the dividend will be more and even your competition entry also will be more. Done, people. With this, all this concepts we have covered. Can we now run through a few questions? We have some time, so yeah, we'll try to run some 3-4 questions maybe. Can we try? Okay. I'm trying to pick, in my opinion, those questions which has repeated more. Okay, that's my, and which also covers the concepts whatever we have discussed. Like that, I'm trying to select the questions. Okay, look at this. Question number 5. I'm as much as possible, I'm trying to take the questions from study material also, so that even our other students who have not taken the class from us, they also try to get benefited. So all those questions you'll be finding from, most of them are study material. In fact, our class note is study material plus RTP, MTP. That's all. Nothing new is there in our class notes also. But any which way. Okay, look at this. Alpha limited, beta limited are identical except for capital structure. Only their capital structure is different. Other than that, they are all same. Alpha has 50% debt to 50% equity. 50% debt, 50% equity. Beta has 20% debt to 80% equity. Only their capital structure is different. Rest everything same. All percentage are in market value terms. Borrowing rate for both companies 8%. In a no tax world, tax is not there. Capital markets are assumed to be perfect, meaning information is freely available. Now, requirement to you as an investor, if you own 2% shares in Alpha, if a particular investor owns how much shares? 2%. Sir, when they say shares, it is always equity shares. Of which company? Alpha. Determine your return if company has a net operating income. So, operating income ka another name is EBIT. If they say operating income is nothing but your EBIT. So, Alpha ka EBIT is how much given? 3,60,000. So, they are not asking company ka return, they are asking investors ka return. And investor owns how much percentage shares in this Alpha? 2%. EBIT is 3,60,000. Overall capitalization of the company KO is 18%. This is what they have given. And they also asked implied rate of return on equity. Implied rate of return in equity is nothing but your cost of equity. So basically they are asking you investor ka return as well as cost of equity. Now people, if you are not able to proceed here, no, some students will be like, how to proceed? Just in your mind, recap the formulas. We have learnt a few, right? First, how do you get value of the firm? EBIT by KO. Here see EBIT given no, KO given no. So you can find value of the firm. Possible. Then value of the firm has one more formula. S plus D. S plus D. Here do you know the composition? 50% equity, 50% debt. S also you can find, D also you can find. Value ka 50% is equity. Value of firm ka 50% is debt for Alpha. Yes sir. Third one is what? What is S? How do you get S? Each divided by cost of equity. Cost of equity we need to find. But hang on. S is equal to basically what people? Each or net income divided by cost of equity. Agreed? This is how you get market value of equity. Agreed? No people, S you already know. Because if you know value of the firm, 50% of the value of the firm is equity for Alpha. So S you already know. Can you find out net income by any chance? Net income is each. How do you find each? From EBIT can you find each? From EBIT can you find each? How? From EBIT you reduce interest. You get earnings before tax. Tax is anyway 0. You will get earnings after tax. Preference shares not there. So EAT only will become each. I mean this also you know. Can't you find out cost of equity? Substitution. That's all. 3 formulas if you recap, you know how to do it. That's all we'll have to do. First do them as a working note and then solve. Done now. Can we quickly review now? Okay, first they have given EBIT and they have given KO. With these two what we can find? Value of the firm. Check. We don't have to solve. First we'll do it for Alpha. How do you get value of the firm? EBIT divided by KO. EBIT 360, KO given 18%. So what is the value of the firm? 20 lakh. Till here any problem? Now Alpha they only told 50% equity, other 50% debt. Me or question? Question. That means you tell me people, if value of the firm is 20 lakh, if total value is 20 lakh and 50% equity, 50% debt means what is market value of equity? 20 lakh ka 50%, which is how much? 10 lakh is market value of equity, 10 lakh is market value of debt. That's your next working note. Alpha. Done now. Now you know S. To find cost of equity, again S ka formula is what? Each divided by cost of equity. S we know. Cost of equity we don't know. But can we find each? Yeah. They've given EBIT. From EBIT we can find each. So that's your third working note. Net income, or you can also call it as each. How do you get each? First take EBIT. What is EBIT of this firm? 3,60,000. 3,60,000. From EBIT you have to reduce what? Interest. How much is the debt, people? Don't reduce 10 lakh. 10 lakh is a debt too. We need to reduce interest. This firm can borrow at what rate? They've given check. Both the firm ka interest rate or borrowing rate is 8%. How much is the debt value? 10 lakh. What is the interest rate? 8%. 10 lakh ka 8%, how much? 80,000. That is your interest. By doing this, you will get earnings before tax. There is no tax. I mean, same thing will be earnings after tax. Since there is no preference dividend, same thing will be net income or each. How much? 2,80,000. Any problem? And now substitute. How do you get S? What is that formula for S? Net income divided by cost of equity. S you already know. What is the value of S? 10 lakh. What is the value of each? 280. S is, or in fact, if you want, this is given, this is given. We need to find what? Cost of equity. What's the formula for cost of equity? If you want to substitute Send this to the other side, send this to the other side. So what will be the formula? Therefore, cost of equity is net income divided by S. Correct, na sir? Or you can use this formula only and cross multiply and get the answer. What is net income we got now here? 280. What is S we got it here? 10 lakh. So 2,80,000 divided by 10 lakh will give you 0.28 or 28%. That's the cost of equity, one of the requirement of the question. Any problem? Next, they also ask, that's it, or also investors return. Investors return. How much percentage shares investor was owning this at? 2%. Correct? Sir, he's an equity investor here, he or she. Right? Equity investors will get a share in EBIT or EISH. What belongs to equity shareholder? EBIT or EISH? How much is the EISH of this alpha? We already found. Net income or EISH is how much? 2,80,000. This 280 lakh is for one shareholder or all the shareholder? I mean, this 2,80,000 is for 100%. Is investor owning 100% or 2%? So what is their share? 2,80,000 ka 2%. 28 2s are 56. So 5,600. That's it. Give you a minute. Observe. Sorted, and now we'll have to do probably the same. Can we go for B, the other one now? This was alpha. Now they check the same question. They say beta ka you have to calculate. Beta has same net operating income as alpha. That means beta ko EBIT is also same. How much is that? 3,60,000. Determine the implied required return on beta limited. Implied equity return means they're asking us to find out cost of equity. Any different or same? Beta also has same operating income, same KO. So first step you tell me, sir. If you know EBIT and KO, what you can find first? Value of the firm. What is the value of the firm ka formula? EBIT divided by KO. If you do it, you'll get same. How much? 20 lakh. But beta ka equity debt same. No, beta is using 20% debt and 80% equity. So can you find out D and S over here? What is market value of debt to? 20 lakh ka 20%. How much is that? 4 lakh is a market value of debt. Equity is 20 lakh ka 80%. 16 lakh. That's a second working note. Same thing. Yes, sir. But to apply that S formula, we need two components. What are those? Net income and cost of equity. Cost of equity we don't know. S we found out. That means we need what here? Net income. Net income ka another name? EISH. From EBIT can we find EISH? Yeah. First, what is EBIT? 3,60,000. Reduce interest. How much debt this firm is borrowing? 4 lakh. Interest rate is they only told 8%. So 32,000 interest. So your EISH or net income will become 3,28,000. Substitute and you'll get cost of equity to be 20.5. Done, Sarji? Any problem, Sarji? And this is proving with our theory also, if you just check. Which approach here? They said net operating income approach. Net operating income approach is relevance or irrelevance theory? Irrelevance theory. What did the irrelevance theory net operating income argument was? Debt is same. Cost of debt is same. Here also 8. That's the reason both the firm ka interest rate different are same. Same. Value of the firm also any change or no change? No change. Irrelevance theory, no. So both the whether you take more debt, you take less debt, overall value will be same. Correct. And one more approach, net operating income said, what is that? Or maybe leave that, it's okay. And in fact, one more also you can prove that if under net operating income approach, EBIT, KO, KD, EBIT, KO, KD, and even value of the firm, all this will be constant. All this will be same. That's the reason all this we are using different data, same data. Check here, all these three are same. No change. Only cost of equity, the theory said, cost of equity will change. Here check, how much is it? 28. Here is how much? 20.5. And it is common sense also. Check here, people. And they ask the reason also. They're asking us to analyze. Why is cost of equity changing? Can someone tell me? Why here it is 20.5? Why here it is 28? What is the reason? Why it is 20.5 and 28 here? Why is it not same? Perfect. So taking debt is more risky. Taking debt is more risky. Now, this firm, Alpha, is using how much debt? 50%. Meaning 10 lakh worth of debt they are taking. Beta is taking 10 lakh debt or only 4 lakh? So here 10 lakh debt, here 4 lakh debt. Which firm is using more debt? Alpha. Taking debt is risky. If alpha is taking more debt, alpha firm compared to beta has more risk. Firm alpha is risky compared to beta. That means equity shareholders of alpha will expect less return or high return. High return. That is the reason beta ka equity shareholders are only ready to settle for 20.5. Because alpha ka risk is higher, alpha ka equity shareholders are expecting more return. Hence 28. That's what you need to write. The reason why it is not changing, why it is not same is both the firms are using different debt. Alpha is using more debt, hence cost of equity of alpha is higher than cost of beta. That's what I've written it as a synopsis over here. Clear, sir? That's a justification. One problem done. No? Can we review a few more? If you want some more time to review the question, I'll wait. Or if you feel I'm comfortable, I'll move on. The numbers looks okay. Conclusion part. What? Tell, show or what? Show. Cost of equity of alpha and cost of equity of beta is differing because alpha and beta are using different levels of debt. Since alpha is using higher debt, cost of equity of alpha is higher than beta. Next question, okay. Next, people, let's take up arbitrage. We said, right? We have not discussed arbitrage. So one question, I will take you through arbitrage. Pay attention. There are 4 problems which can come. It's study material question only. This 6, 7, 8, 9 in our class notes. But we will not have so much time to go run through everything. And one is good enough. Only few points are different. So one I'll take you through. Observe. Or you want to do this at the last and cover the first. Can we first maybe cover off the things we have done so that we can recap them and then come back to this? Okay, maybe remind me then if I forget. Okay, now people, you remember in approach, was there any linkage between cost of equity of the levered firm, cost of equity of the unlevered firm? Yeah, there was one formula. Tell me, reiterate that formula for me. Call it out. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus, open the bracket, cost of equity of the unlevered firm minus cost of debt into debt into 1 minus tax rate divided by equity. KD here is not cost of debt, it is interest rate. Then now application is this problem. Can we review? It's same. I think same question is there in your this attempt RTP also. Okay, I think they've just changed the name and some values. Pretty much the same. Now check. Blue Limited, an all equity financed company. All equity financed company means 100% they are taking the money from equity. Debt is there or no debt? No debt means it's a levered or unlevered firm. UL firm. UL firm andre unlevered firm. Currently, this firm is considering repurchasing 275 lakh rupees 275 lakh. I mean, this 275 is the value of equity shares and replace it with 15% debentures of the same amount. Currently, they have only equity shares. Now, what is the plan of this company? To buy back the equity shares. Buying back means cancel the equity shares worth how much? 275 and substitute with debt. That means now, will this, after they do this exercise, will they still be unlevered firm or now they will become levered firm? Because now they want to substitute with the debt. How much is the debt value? Same amount. Same amount andre 275 lakhs. Current market value of the company is 1750. Currently, what sort of a firm is this? Unlevered firm. And unlevered firm ka current value is 1750 lakh. With cost of capital, how much? 20%. Done, Aji. Now, everyone just observe. Currently, firm has what and all? Only equity. Only equity. That means, can I say here, currently, KE is equal to KO is equal to 20%. Do you agree? Because only source of available with the company now is cost of equity. How do you calculate KO? Weights multiplied by the cost. 100% equity means what is the weightage of equity? 1. So that means cost of equity itself will become overall cost of capital. That's a current setup. Do you agree with me? Because other than equity, we don't have any other source of finance at all currently. Yes. The company's EBIT are expected to remain constant in future years. Oh, it's okay. Tax rate how much? 30%. As per MM approach, you need to calculate three things. Market value of the company. So market value given, no sir, 1750. This is the market value of the unlevered. Now they're planning to repurchase, no? And substitute with debt. Now it's a levered firm, or now it's unlevered firm or levered firm? Levered firm. Once the company issues debt, they will become levered. That levered firm ka market value they're asking. This is the market value of the unlevered firm. Now we have to find out market value of the levered firm. Also they are asking us to find out KO. Done. And they're also asking cost of equity. All this you need to find after the firm has traveled from unlevered firm. It has become from UL. It has become L firm. Done, sir. Now, when you see such questions, suddenly things will not click. How to start? You'll not be able to hold the pen and be like, tuck, 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 tuck. No, it doesn't work. It works for accounts and few subjects. But for FM, no, hands will not freely move. Because there are multiple formats, so multiple formulas, so many things, so much of drilling, so many questions. So in this chapter only, we must have solved like at least 40 questions. And when we have solved so many things, suddenly we'll not remember. So the best way to come out of that rut feeling is MM approach. There are only 3 formulas for MM approach. Recap that once for your, in exam, recap it in your mind. Now you can call it out. How do you get? If there is no tax rate, both the firm ka value should be same. 1 minute, people. Here tax rate is there. That applicable, not applicable. Cut it off. Next, what is the next equation? If tax rate is there, how do you get market value of the levered firm? Take unlevered firm ka value given 1750 plus tax benefit. Tax benefit, how do you get? Total debt multiplied by the tax rate. That is also given. I mean, you can easily do up the first step. What is first step? That. Can we do off that? No. And then proceed further maybe? So what is the first step, people? Finding out the market value of the levered firm. How do you get levered firm ka market value? Take unlevered firm ka market value and add the tax advantage or tax benefit. Currently, what is the market value of the unlevered firm? 1750 lakhs. So that's your unlevered firm ka market value. Plus tax benefit. How much debt they want to take company? 275 lakh. Multiply by the tax rate. That's your tax benefit or tax advantage. So what is the value, people? 1832.5. Done now. They also ask us to comment. When they say comment, you just say how much it was before, how much is it now, and they just call out. How much was the value of the firm before? Before replacing with the debt, value of the firm was 1750. Now it has become 1832.5. So that means value has reduced or increased. Value has increased by how much? From here, it has become this number, it has become this number. So what is the change? 82.5. That's all. Done now. Second formula, we recapped it and we solved it. Now next, what is any other formula is there? They anyway ask cost of equity. Right? Now it's an unlevered firm or levered firm? Levered firm. 1 minute. Now we need to find out cost of equity of the, what firm is this now? All this is for the, all this we have to find out for the levered firm. Agreed? Clear? Now people, is there any connection between cost of equity of the levered firm and cost of equity of the unlevered firm? Is there any formula linkage? Yes. Now before this particular buyback option, company had only one source of finance, which was what? Cost of equity. So what was the overall cost of capital they had given? 20%. Actually this is KO. This is KO. But only one source of finance is there. Therefore KE and is equal to KO is equal to 20%. Done now. This is what? This is what? Levered firm ka or unlevered firm ka? Unlevered firm. Sir, unlevered firm ka cost of equity, if you know, can't you find out cost of equity of the levered firm? There's one anyway formula linkage. Yes, that formula. What is that again? You tell for yourself. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm. That's cost of equity of the unlevered firm minus cost of debt. Finish. Yes, sir. Unlevered firm ka cost of equity, how much kana? 20%. Minus cost of debt. What is the cost of debt here, people? Cost of debt here is the actual cost or interest rate. How much is interest rate? 15%. You can take decimal or you can take directly percentage. If you take percentage, final answer also will be in percentage. If you take decimal, final answer will be in decimal, which you have to convert it into percentage. Your choice. Into debt into 1 minus tax rate divided by equity. Yes, sir. But 1 second, hang on. before you substitute this formula, what you need D and you need equity. That means you need to put one working note. What is that? You need a market value of debt as well as market value of equity. I think debt is already given. It's very straightforward. What is that? Or in fact, directly also you can do it. What is the debt value? 275. Correct? No. So debt ka value you already know. How much is that? 275 into 1 minus tax rate. What about equity? That also, if you want, you can do it one line. What is the market value of the company? Just now we got what is the market value of here? One minute. The market value of the company now is 1832.5. 1832.5. Sir, second equation. Tell me that second equation. V is equal to S plus D. V is equal to S plus D. If you know V, if you know D, can't we find out S? How do you get S? V is equal to S plus D andre. S is equal to V minus D. What is D? 275. Reduce automatically, you will get 15. That is what is the next working note I put over here. V is equal to S plus D. V you already know, D you already know. Therefore, S will be these two come minus, which is 1557. If you don't want to do this working note, directly you can show like this also. That's also fine. Done, sir. And that way you will get cost of equity of the levered firm. Cost of equity of the levered firm. How much was the cost of equity before? Before you did this exercise, cost of equity was 20%. Now it has become how much? From 20, it has become 20.61. Reduced or increased? Increased. Because you have taken more debt. No. The moment you take debt, business becomes risky. If business ka risk has increased, means equity shareholders will expect same return or higher return. Hence, from 20, they are expecting 20.61. This is a change. Done, sir. So, three things they asked in the problem. What are those three things? Market value of the company found. Cost of equity found. Overall cost of capital is KO, na people. And that is very. Now you have after the firm has become levered firm, it has one source of finance or two sources. What are those? Debt to equity. Now you can use that KO ka table. Debt ka market value you know. Equity ka market value you know. Debt ka cost you know. Cost of equity also you know. So either use the WACC ka table and get it, or use formula. What is formula? What is that one-liner formula? KO is equal to weight of debt multiplied by cost of debt plus weight of equity multiplied by cost of equity. Okay, now people. Weight also, how do you calculate? That is also very straightforward. Total market value, how much? This. In this, how much is the market value of debt? 275. So how do you calculate that? Out of 1832.5, 275 lakh is through debt. So how much is the market value, people? 275 divided by 1832.5. How much you going to get? Weight is 0.15. Agreed? That means equity ka weightage will be 0.85. Either use table approach KO ka or simply use one line of formula. And you will get the KO to be 19.09%. Okay, na sir? That's all. It's a good question. So whenever you get stuck, best way, format and formula you try to recollect. That will definitely give you a guidance as to how to proceed. If you're not able to at least solve the question fully, at least 50 to 60% of the question you will be able to solve. Worth it. And people don't freak out. I've seen so many students, we keep telling this time and again, but still maybe once you go to the examination hall, you become different person, I think. Suddenly you will expect too much from you. Right? I do understand where you come from. Maybe since you are in CA intermediate level, maybe still coming. What usually happens is, sir, usually when people shift from that 11th grade to, let's say you have done from 11th grade or 12th grade, you did BCom and then you have come to CA. In 11th to 12th and all, they'll be all, many of them will be scoring in 90s or 95, 100 on 100. So our score will be quite high. I'm sure, I think these days it is common to score 100 on 100, correct? BCom also, let's assume that you have scored quite well. They're laughing. Sir, we never attended class. We were full calm. Yeah. Especially when you shift from 12th grade to CA, there is a drastic shift which has happened. No? But the mentality will not shift. Students will be still like, I want 100 on 100. It doesn't work like that in CA. Because time. It was always think 3.5 hours ka paper you need to attempt in 3 hours. That means you already have how much shortage? 30 minutes shortage. So when you have already shortage of time, and so many of us don't have so much of writing practice. Most of us try to review the questions. One or two we will solve, others we will keep on reviewing. And even if we are solving it, we will take our own sweet time, black ink, red ink, chicky ink, and yeah, we'll keep dilly-dallying there. Yeah, most of us have that habit to draw the lines, so neatness and all that. You have to forget all that. Throw literally the pencil scales out. It doesn't work out anymore once you come to the inter-level onwards. So time we'll forget. So keeping those parameters in mind, right? In CA level, 60 is equivalent to scoring 100 on 100 in your previous level. 60 is because you need to be really good in terms of your preparation, in terms of your time management for you to score above 60. It's not that easy. Only not paper is not difficult. You should also many of the times you know the answer, but still you will not be able to write it because of lack of time. And sometimes people, right? And I think this not even sometimes, many times. The moment we see we took first question. The first question I always say is a killer. At first 16 marker question, we will write. We see 1.5 hours gone. Oh boy. 16 marks attempted. How many? 1.5 hours gone. Remaining 1.5 hours, 84 marks to be attempted. And now full rocket. Now what and all you'll write? It's like my handwriting. Yeah, you will go on. Right. And when that pressure hits you, right, we start forgetting the basics of basics. Something which we can do it in our left hand. Somebody who's a lefty who can write in our right hand, that also we will forget. So that pressure can kind of bring you down. So you need to learn to manage that with the help of writing mock papers. Ideally, this is a time to write some mock papers to sort that out. If you are not in that category, if your still preparation is pending, okay, no comments, let's try the best. Okay, that's all I would say. Fine. So considering all these parameters, I feel, okay, go easy on yourself. 1 or 2 mistakes if you do, don't freak out. Just say expected. One word. Just say part and parcel of the course. Mistakes are expected. You don't have to overthink, because the moment you think I did a mistake, then you'll start forgetting what you're about to do next. If you're thinking about mistake, you'll start doing more and more mistakes. We don't want that, right? Even if you feel, well, sometimes we know that we did a mistake. We'll get to know a little later. When you're writing the paper only, after 15 minutes, you know that this is wrong. It's okay. Learn to forgive yourself. Don't take it to the heart. It's okay. It happens. Okay. Chalo macha. Let's move on. Convince yourself. So let that pressure not get you. And to pass the examination, marks required is only 40. Aggregate mein 50. So ICA is only telling 50% of the things you can go wrong. 50% of the things you can go wrong, I will still make you chartered accountant. It means ICA only is saying, it's okay, I am happy even if you are 50% cooked. Doesn't have to be 100% cooked. Only 50% is good enough. So go easy on yourself. It is good. 60 is amazing marks. 50, 55 is also amazing marks. You are a chartered accountant. You will be a chartered accountant. Fine, Sarji. So go little easy. Preparation wise, go hard on yourself. As much as possible, try to cover up. But when you come to the examination hall, last 2-3 days, especially before the exam, go a little easy on yourself. Say that few things can go wrong. I might forget few things, right? Or some new question may come, new adjustment may come. It may come, Allah. It will come. Why may Allah? It will come. I'll only tell you. 20 marks, it doesn't matter whom you have taken the coaching at All India level. 20 marks in every paper, every attempt will be a new setting. It will be altogether new question. No teacher would have done that. Because every teacher mostly does study material and RTP. If that question is not even there in study material and RTP, how will that teacher also do it? But I'll go and create these questions. Covering existing question only full, sweating. So much they've added. Now we'll go on creating new questions and solve. No. So like that, some 15 to 20 marker will come. So don't worry about that. Focus on the other part which you are comfortable. And go little easy on yourself on the examination day. And after the paper is over, no postmortem. No postmortem. 1 mark, 2 mark, 3 mark. Lekka pakka, you can do it later. Yeah, you don't have Rashtra. So you do it once the paper is done. Do not do it when when the exam is over. Come back and do it. Psychologically it will pull you down. You can't do anything about it. Throw the paper. Best. Tear it off. Yeah, imagine FM. Sandesh, what did you teach? Nothing. Yeah, put it on me. It's okay, fine. Best, right? But that paper should not be in your sight because many people, we are not mentally strong. The moment we see the paper, we'll be like, at least once, 5 minutes, 5 minutes. Then you will go to YouTube, somebody would have done review, right? You will see that review. Oh, MCQ going da. Oh, people why all that required? Chumma psychologically very back foot. You are unnecessarily putting it. Not required. What you can do, even if you scored out in MCQ, big deal. Over, no. Leave it. That attempt, best according to me, throw it off. Burn it. Throw it. Whatever you want to do it, but the paper should not be with you. Later you can download from ICA website if you want. ICA posts it there. Best. So, go a little aram se yourself on those examination days. Not now. Now you go bonkers. Whatever you want to do. Right. On the examination day, little easy on yourself. Okay, people? Alright, but I'm pretty sure it will happen. Keep this calm. It will work out for you. All of us have become chartered accountants. You believe that I'm a CA? Thank yeah, fine. Sometimes when we shave, they'll say, you're CA? Yeah, CA only. Yeah. Alright, though we cleared very long time back ago, but the pressure and the things has not changed. Right? Now also, like I qualified in 2012. Probably more than 14-15 years back now, right? The pressure it was at that time. Though now I see pretty much same, or maybe it has increased because you people have your social media ka drama, no? Right? Papa, you're worried now. I did not pass means how will I show my face on my social media? That is the problem for us. No, for us that was not much issue because we all had a touch phone. Keypad, a dial phones, over here is called. So most of us, I think post CA only, I think we started using I think back then only smartphone came. Otherwise, mostly it was a touchpad phone only. So that way our social media was little fine. Facebook and all, everything we had to log in through desktop. Who will log in through desktop every time? No, that will be boring. So we were little away, half an hour, 1 hour we used to spend and come back. But for you, everything you're holding, dunya tere mutti mein types, no? Everything is in phone only. Everything, that's a blessing as well as a biggest curse. Right? Because she's saying curse only. Give me your phone, ma. I'll keep your curse for you, please. I'll auction it for you if you want. Alright. So that's the thing. So overall, that's all I'm trying to say. As much as calm you can keep yourself, the better chance you are giving for you to crack that examination. Go. Alright. So this particular problem, we solved this pending. You also don't know. You also forgot. I also forgot. So I think this one is done. Okay, we'll move on to the next one. This one is also a popular question. They keep altering this in one way or the other, but it keeps coming in many forms. But more or less the benchmark is same. So 14, it's again a study material question, quite popular. So let's see what we can learn from this question. Couple of hidden things are there. Read the question carefully. Now, PBIT, you can call it as EBIT or you can call it as PBIT, one and the same. How much? 52 lakh. From that, they've reduced interest. PBT, they've got to. EPS, they've got to. P ratio. Sir, how do you get P ratio? Name only there is P ratio, macha. Contribution. Where is contribution coming? Not operating leverage, macha. P ratio. Name only there is formula. Price earning multiple. So it is nothing. Price here refers to MPS. E here refers to EP. From MPS, if you divide EPS, you will get price earning multiple. How much is that? 10. What is the meaning of P multiple is? If company has an earnings of 1 rupee, if company has an earning of 1 rupee, if company has an EPS of 1 rupee, investors are willing to pay 10 rupees of that earnings to buy company ka shares. For 1 rupee earning, investors are willing to pay 10 rupees. That's what P multiple tries to calculate. Now people tell me, if P multiple you know, EPS you know means, can't you calculate MPS? How do you calculate MPS here? P multiplied by EPS. These two you multiply. 25. That's your market price. That's the data they've already given. Okay, now what do we need to do? 1 minute, some hidden things are there over here. How much is the number of equity shares? Number, value. Okay. Now, I don't know, one student asked this doubt too in recorded level. I don't know whether you also may face this. So his doubt was, sir, this is amount column. No, this is amount column. So that means this 8 lakh is not the number of shares, sir. It is the value of the shares. No, people, when they say clearly number of equity shares, I mean this 8 lakh is not the value, it is the number only. Okay, na? Yes, sir. You got the doubt now. I put unnecessary ula. Okay. Yeah. So when they say, even if they say amount here, if they say number of equity shares, I mean this 8 lakh is the number of equity shares only and not the value. 8 lakh is the number. What is each share ka value? 10. That means what is equity share capital? 8 lakh shares of 10 each means equity share capital will be 80 lakh. That is one. Done na. I say it does this because they will not have multiple amounts column. So they will put in. Okay. But when they say clearly number, this is the number only. Now one more. Sir, can you find out debenture ka value? Is there any way? If interest amount is given, interest rate is given, is there any way to find out debenture value? How? Interest amount divided by expected interest rate. Here expectation and actual are same. How much? 12%. Interest amount 12 lakh divided by interest rate you do. How much are you getting? 1 crore is your debenture ka value. Done na sir ji? 100 lakh or 1 crore? Easy. These two are hidden adjustments which we need to keep in mind. Okay, next. Company is planning to start a new project with a capital outlay of 40 lakh. For this new project, how much money they require? 40 lakh. You are informed that debt equity ratio. How do you calculate this debt equity ratio they have told? Debt divided by debt plus equity. If you do that, and if this number crosses 35%, when you do debt divided by debt equity, debt plus equity, and if that number crosses, it is higher than 35%, then the cost of equity will become 12.5 and it will reduce P multiple to 8. Currently, what is P multiple? 10. If debt equity ratio crosses 35%, from 10, P multiple will become 8. And interest rate, currently what is the rate of interest we are giving on our debt? 12%. And the interest rate on additional amount borrowed will become 14%. So this new 40 lakh, whatever you are borrowing, if you borrow through debt, it will not be at 12%, it will be at 14%. All this will happen only if debt equity ratio crosses 35%. Otherwise, all the data what you have seen here will hold good, will remain same. Now we need to find out probable price of the share. Probable price of the share means they are asking MPS. If first case, two case, additional funds are raised as loan. How much money you want? 40 lakh. First case mein 40 lakh is coming through loan as in debt. Second case mein amount has come through equity shares. Read one more data bracket mein they have given retained earnings is how much? 1.2 crores. Okay na sir? Clear? And this is what they have given. That means people, if I'll have to really break down the components of capital structure, break it down. How many components are there? 1 na, 2 na, 3 na? 3. Break down each. Equity share capital separately, retained earnings separately, debt separately, preference share separately. Like that, if I have to separate each component, there are 1 component here, 2 or 3. 1, 2, 3. Understood my question? Understood my question. Didn't understand. If you split the capital structure as equity share capital, retained earnings, debt, preference shares. Like now I called out how many? 4. Like this, if you split in this problem, how many are there? 1, 2, 3, 4. 1, 2, 3, 4. Which? 3. What are those? What dumb questions, sir. Here only you have written equity share capital, debt too. Also don't forget retained. Yes, Saji. So can you tell me currently what is capital employed? Take your calculator and tell me. What is debt ka value? 1 crore. What is equity ka value? 80 lakh. What is retained earnings ka value? 1.2 crore. 1.2 crore is nothing but 120 lakh. So I added, how much are you going to get? 3 crore is my current capital employed. Do you agree? Because in FM mein capital employed means long-term source of finance ka total. 3 crore, paka. How much EBIT you have generated? 52 lakh. The whole problem in this question is they asked MPS. But to calculate MPS, we need 2 data. What are those? EPS and PE multiple. At least PE multiple we know. Currently it is 10. If debt equity ratio crosses 35%, it will become 8. So PE multiple, no problem. What about EPS? To calculate EPS, what do we need? Now don't say this so. Sorry, EPS is given as 2.5. No. Now we are doing new project. No. When you do new project, you will get same EBIT or EBIT will increase. That means same EPS you will get or it will change. Now you tell me, to get EPS, what is the formula for EPS? Each divided by total number of equity shares. Total number of equity shares I can find, that's not a problem. What about each? From EBIT you have to derive each, correct? How? Reduce interest to blah blah. Yes, but how much EBIT you will get because of this new project? Given or missing out? When you're doing a new project, nobody will get zero EBIT, correct? No. If you're doing new project, means obviously we will get some EBIT, maybe 1 lakh, 2 lakh, 5 lakh, 10 lakh. Given or missing out? Missing. So that means if new project ka EBIT is not given, then how do you find out total EPS? If you can't find out, how can you find out total MPS? Understood the pain point of this question, where we're getting stuck? Okay, that is the where we are currently stuck. Correct, Ji? Now how to sort that? Very simple. You remember we used to calculate something called ROS, not your Valentine Days ka ROS. Here ROS means what? Return on capital employed. How we used to calculate return on capital employed, people? EBIT divided by capital employed into 100. Yes, sir. This is what we have to use here. Currently, what is my EBIT? 15 lakh. Currently, what is my capital employed? 3. That means what is my current ROS? 17 point some percentage. Now you tell me, people, if I'm currently, ROS ka full form is what you tell me? Return on capital employed. Meaning on how much ever capital. Sir, to do a project we need capital. So what is your return on capital here? You're getting 17.33. So if I raise any money as capital, how much return I will expect from that capital? 17.33. Now I am raising how much capital more? If my existing return is 17.33%, means for new project also, at least I will expect same return, right? At least I will expect that much or more. Yes, ideally more. If not more, at least 17.33. Why 17.33? Because that is my existing project ka return. Yes, no. So here what is the assumption? New project also will generate a return of at least 7. That way you will be able to calculate new project ka EBIT. 40 lakh ka 17.33 if you do, you will get new project ka EBIT. That's all. Okay na, Sirji? That is the first hidden adjustment of this question. For that, first we need to find out all the components of capital employed ka breakup. That's what I've done here. You got the thing, one hidden adjustment of this question. See here, that's what I've written here. Existing debenture value, they had not given. How did we find that? Interest amount divided by interest rate. We got that. And equity share capital they had given, retained earnings they have given. So what is the existing capital employed like you told? 3 crore. What is the EBIT? They had only told. Currently, what is our EBIT? 52 lakhs. So existing EBIT is 52 lakhs. Sir, how do you calculate ROS now? What is our existing ROS? EBIT divided by capital employed. 52 lakh divided by 300 lakh if you do, you will get an existing EBIT of 17.33. Till here, okay. Now, how much money we are raising extra for new project? 40 lakh. That means is our capital employed going to be 300 lakh or 340 lakh? From 300 lakh, it will increase by 40 and it will become 340 lakh. Correct? And how much return do I expect on my capital? 17.33. And how much is my total capital now? 340. So how much return will I expect? Whatever is my capital, on that I will expect a return of 17.33. Means what is my new EBIT now? 340 lakh ka 17.33, which is 58 lakh 92,200. Easy na, people? Yes. Previously, how much it was before new project? How much was my EBIT? 52 lakh. Now it has become what? From 52, it has become 58. That extra amount we have got it from new project. If you want also, you can also calculate that. How much is the new project ka amount to? 40 lakh. 40 lakh ka 17.33% you do. You will get some amount. 6 lakh and 3. To that you add existing EBIT 52 lakh. How much is that? Add 52 lakh to that number. 58 lakh 92,200. Like that also you can work out. Your call how you want to work it out. One way or the other. Done, people? Now you tell me, is this new project ka EBIT alone or existing plus new put together? This is existing plus new put together. Yes, sir. So one feeling, one thing what we need to sort out, we have sorted out. Next one is they told some drama. What is that? That drama was based on debt equity ratio. Can I go to that drama? Now what did they say in the problem? If debt equity ratio crosses 35%, then P multiple will become 8 and new loan you have to borrow it at 14%. All this drama will happen only if debt equity ratio crosses 35%. And how do you calculate debt equity ratio? They only told debt divided by debt plus equity. Okay. Let's take up the first case. Sir, in first case, what is the assumption? Or what is the first case? Additional fund. Additional fund is 40 lakh. It is coming through loan. Loan as in debt. Currently, what is my debt value? 1 crore. How much more debt am I borrowing? 40 lakhs. So let's find out the debt equity ratio. See, I've written here. What is the total capital employed after the new project? Just now we wrote 340 lakh. What is the total debt? We already have 100 lakh. Now 40 lakh we have borrowed more means now the debt will become 140 lakh. So what is debt ka weightage? Basically they're saying debt ka weightage. Out of 340 lakh, 140 lakh is through debt. So calculate debt divided by debt plus equity. 140 lakh divided by 340 lakh, which is 41%. 41. Okay, no issues. Hit for 0.0% and all, let's not fight over it. What is the debt? Did it cross 35%? Did it cross 35%? Yes. Because the benchmark they told in the question was if debt divided by debt plus equity, if it crosses 35%, few things will happen. What are those? P multiple will not be 10. It will become 8. Now, existing interest rate was 12%. Now, can you borrow at 12% or 14%? This 14% is for the existing and new or only new? Additional they told. Other additional. Don't forget that keyword. Interest rate on additional amount borrowed will become 14%. Existing debt ka interest will still be 12. Whatever new debt you take, that interest rate will become 14. That's what we have summarized over here. This will happen in first case. Clear? Which case is this? When 40 lakh money is raised as a loan. Okay. Now what is the case 2? That 40 lakh you will take through debt or equity. So let's test it out. If the same 40 lakh is raised through equity shares, what will happen? Total capital employed still 340 lakh. What about debt now? Existing debt 100 lakh. That new 40 lakh came through debt or equity. That means debt is still how much? 100 lakh or 1 crore. Yes, sir. Calculate debt divided by debt plus equity. What is debt ka weightage now? Out of 340 lakh, now debt ka weightage is only 100 lakh. How much is this? 29. Did it cross 35%? If it does not cross 25%, P multiple will stay at 10. P multiple will stay at 10. That means what is the existing market price? 25. This will also be same. Existing market price. Why have I written this is? Now 40 lakh you are raising through how? Equity shares. Right? And what is the market value of one equity shares? 25. So how many equity shares you will have to issue? Totally 40 lakh you need through equity shares and the market value of one equity shares is 25. So how many extra equity shares you have to issue? 40 lakh divided by 25, which is 1,60,000. Currently we already have, I think, how many shares? 8 lakh shares. We already have 8 lakh shares. In second case, if 40 lakh is coming through equity shares, means how much additional shares will be rolled out? 160. We need this for EPS calculation. Don't forget that. Done now. Once this is sorted, over. Till here if you have sorted means, then remaining is just format. Okay people, what did they ask? MPS. To calculate MPS, we need two data. What is that? P multiple, EPS. First, that means you need to calculate EPS. For that, we need EISH. EISH they have given or we have EBIT. So start with EBIT and first get EISH. And then calculate EPS. And then take P multiple and calculate MPS. That's the approach. Can we do it? Can we do it? What is the expected EBIT? 58 lakh, 92, 200. Sir, whether you take the money through equity shares or whether you money through debt, the new project ka EBIT will be same. How much? Because of this option, interest will change. EBIT will be same. Okay, no? Because this is earnings before interest and tax. Understood? No, because of your financial plan, EBIT will not change. I used to give this example. Now, just because, now let's say we are opening, let's say we opened a new branch in Hyderabad. We opened a new branch in Hyderabad. Now we put one big holding, big board. You know what board? For Hyderabad, to open branch, we needed 50 lakh. How much money we needed to open that branch? 50 lakh. In that banner, you know what we printed? 50 lakh is raised through debt. Please come. 50 lakh money we have raised through debt. Please come on one side of the board. Another banner may be printed. Okay, 50 lakh we have raised through equity shares. Please come. Students will come. Just because I have raised the money through debt, I will get 100 students. Or just because I have raised the money through equity shares, 100 students will come. That means, what am I trying to say? How you raise the money has no impact on your EBIT. Right? Because of your plan, what will change? Because of your source of finance, interest will change. Interest will change. EBIT will be unaffected. Hence, whether you raise that 40 lakh through debt or equity shares, EBIT will be same for both the plans. Done na, sir? From EBIT, how do you get each? First, reduce interest. Here we have only one interest or two interest. One interest on the existing debt that they have only given. How much is the interest on existing debt? 12 lakh. Will this change or it will remain? It will remain. So, both the plan, this will be there. Now, what about new debt? Sir, first is a case where 40 lakh money is coming through debt. But did debt equity ratio cross 35%? Yes. That means on that 40 lakh, we will borrow it at 12% or 14%. 40 lakh or 14%. How much is that? 5,60,000. Here you are borrowing that extra money through equity shares. So interest on new debt will come or zero. By doing this, you will get earnings before tax, reduce tax, and you will get earnings after tax. Since there is no preference shares, earnings after tax and each will be same. Need a minute to review this. Okay, to calculate EPS, we need two data, each and what is the other one? Number of equity shares. So here also we have two number of equity shares. What are those? Existing, new. What is the existing number of shares? 8 lakh. That will be same. New share. Sir, if you raise the money 40 lakh through debt, new equity shares will come. No, that means here new equity shares will be 0. But if you raise the same money through new equity shares, how much extra shares will come? We already found out here in working note number 3. How much is that? 1,60,000. So that means what will be the total number of equity shares? 8 lakh plus 0, 8 lakh. 8 lakh plus 160, 960. Each divided by total number of equity shares. If you do, you will get EPS. Okay, now. They asked EPS or MPS. How do you get MPS? EPS multiplied by P multiple. But hang on. When you raise the money through debt equity ratio cross 35%. When debt equity ratio crosses 35%, will the P multiple be 10 or it will become 8? 8. And second case, did it cross? No. That means P multiple will be 10. So for first case, P multiple will be 8. Second case, P multiple will be 10. Okay, now multiply these two to get the MPS. That was the requirement of the question. A good question with few adjustments. Okay, sir. Just walk me through this question. What is the takeaway of this question? New project ka EBIT given or missing? Missing. Hence, we first find out ROEs. ROEs means return on capital employed. How do you get that? EBIT divided by capital employed. So whatever was our existing ROEs, at least we will expect the same ROEs from new project also. So that way we calculated the new EBIT. Old plus new project ka EBIT put together we got. Then they said some drama about we need a 40 lakh. We had two options to raise that money. Either go for 100% debt plan. First option. Second option, 100% equity option. But they told no matter what you do, if debt equity ratio, debt by debt plus equity, if that number crosses 35%, few things will change. PE multiple will become 8 and new loan will have to be taken at 14% borrowing rate. When we calculated under debt option, debt equity ratio became 41. Hence PE multiple will be 8, new borrowing will be 14%. But the same 40 lakh if you borrow through equity shares, did the debt equity ratio cross 35% or it was within 35? Since it was within 35, PE multiple will be same, 10. And current market price of the share unaffected. What is the current market price? 25. 40 lakh money we need and on one share we can issue it for 25 means how many shares, extra shares we need to roll out. 1,60,000. Rest everything, plug it into the format, normal format, you'll get the EPS and MPS. That way, good question. Move on to the next, Sarji. Pakka. Still time is there, no? Not hungry, no? He's saying break. Hey, no, we'll finish. No, when we start the topic, no break. You can finish. If you want 2 minutes, yeah, I will chill. You drink here only. Or you want to go fill it out? Yeah, that's okay. That you don't have to ask. But long breaks, no. We'll finish the topic and then only break. Like that. Uh, 1:15, 1:30 I'll give you. Should be done. Okay. 1 or 2 more questions. Okay. Or at least I'll figure out. Okay, this one I'll do. Okay, people. This one, no. 1:15 to 1:30. Somewhere that we should be able to give you a break. Okay. If you want a break. If you don't want a break, we will do leverage and by 2:45, 2:45, bye-bye. One of the two. Your call. That you tell me after this this one is over. You let me know. I'm comfortable either ways. And they're saying now only you leave, sir. Better. That is the best option. Can we review question number 18? This is a straightforward question. No? Nothing much over here. You remember financial break-even point and indifference point? Just a quick revision of this question. I'll read the data quickly. 5-10 minutes we'll run by. Ganapati Limited is considering 3 financial plan. How many options? 3. How much investment we want? 2 lakh. First option, no people. They're calling it as plan A. Second one is plan B. Third one is plan C. First plan, entire 2 lakh will come through equity. No debt, no preference shares. Second plan mein 50% money through equity, 50% through debt. 2 lakh ka 50%, how much? 1 lakh. Other 1 lakh will come through debt. So second is odd option, equity plus debt. Third one is equity plus preference shares. 50% money through equity, no debt, 50% through preference shares. Cost of debt 8%, preference shares 8%, tax rate 50%. Equity shares of face value 10 will be issued at a premium of 10. Face value is 10 and they'll be issued at a premium of 10 means what is the issue price? 10 plus 10 which is 20. EB80 given 80,000. Done. First they are asking very waste question. No? EPS. How do you find EPS? They have only given EB80. No? From EB80 first find EPS. It's very simple. No? You want me to run you through this question? Huh? EPS part, can you take care of it? I've solved it here. I'll just quickly show. We have 1 option or 3 options. First option is 100% equity. Second is 50% equity, 50% debt. Third is 50% equity, 50% preferences. Doesn't matter which plan you go for. Will EB80 change or same? Same. From EB80 go on reducing interest. Which option has an interest? First option has interest. First option is 100% equity. Third option is equity and preference shares. Only plan B has equity. Or plan B has debt. How much debt? 1 lakh. What is the interest rate? 8%. So go on reducing, but don't forget to reduce preference dividend. From earnings after tax, we have to reduce preference dividend. Only then you will get each. Okay, sir. But one thing, I just want you to tell me number of equity shares of each plan. Can you tell me that? Calculate that for me. How much is the number of equity shares here? Question we need, sir. Okay. Sir, face value 10, no? Issued at a premium of 10. Issued at a premium of 10. Face value is 10, issued at a premium of 10. First option, what is the total number of equity shares? How much money we need from equity shares? 2 lakh. Okay, what is the issue price? 10 plus 10 which is 20. Totally we need 2 lakh. Each share ka price is 20. How many shares? 2 lakh divided by 20 which is 10,000 shares. Correct? In second option, 50% money will come through equity. Totally we need 2 lakh. Of that 50% means how much money will come through equity shares? 1 lakh. Each equity shares ka issue price is 20 rupees. 1 lakh by 20, how much is that? 5,000. Third option also same. 50% equity, 50% preference shares. So number of equity shares will be same. And that's your EPS. Okay, na sir? First requirement, very, very basic. Sir, I will use indifference point ka formula, sir. You can. There is another formula for indifference point EPS. What is that? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. If you don't want to do all this, you can solve like this also and get the answer which I have shown it to you. Your call. Absolutely no problem. How you want to present is your choice. And next, what is the second requirement? Financial break-even point. Now, I will show you the data. You will tell me the answer. Here, I'm showing you the data. Financial break-even point. First plan ka you tell me, sir. First plan is 100% equity. For a 100% equity plan, financial break-even point means EPS should become 0. When will EPS become 0? Only when EBIT is 0. Correct? So, first answer is EBIT should be equal to 0. Second plan ka tell me. Second is equity and debt. If you have equity and debt, EBIT should be equal to interest charges. How much is interest charges? 8,000. Yes, sir. So, first plan mein, what is the answer? EBIT should be equal to 0. Second plan mein, EBIT should be equal to interest charges. Third plan mein, it is 50% equity and 50% preference shares. What is financial break-even point for preference shares plan? Preference dividend, EBIT is equal to preference dividend? No. EBIT is equal to preference dividend divided by 1 minus tax rate. What is the preference dividend? 8,000. What is the tax rate? 50%. Solve this for me. Preference dividend is 8,000. Tax rate is 50%. Preference dividend divided by 1 minus tax rate. 16,000. Done now. Any problem? Usually financial break-even point, they will either ask as a 1 or 2 marks ka MCQ or club it with a bigger question. Separate question will not come. Done. Next, they asked indifference point. Or maybe I'll read the data for you. Indicate any plans dominate. Indicate any point, any plans dominate and compute the EBIT range among the plan of indifference. Maybe we didn't understand the question fully. No worries. At least they said plan of indifference. That means nothing but indifference point. We have 1 plans or 3 plans. Now people, indifference point means what? What should be the EBIT so that both the plans give you same EPS? Indifference point compares only 2 plans at a time. You can't compare 3 plans at a time. It's only 2 plans at a time. That means first you'll have to compare A with B. Then compare A with C. And then compare B with C. That means how many times we need to find out indifference point? Okay, now all will be same or different? Okay, you know how to calculate that? What is the formula for indifference point? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Same thing will be equated with EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. This we are doing comparison between A and B. Prabhu, don't take EBIT 80,000. This is project ka EBIT. This is project ka EBIT. Indifference point is a level. It's a benchmark. We need to find that. If you take 80,000, I will leave the class now only. Well, I'll give break now only. This is a project ka EBIT. We have to find what is indifference point. That means when you substitute in this equation, is EBIT given or EBIT is pending? EBIT we don't know. That is what we are about to find out. Rest all the data you substitute. Like I1. In first plan, we are comparing A with B. In plan A, what is the interest? 0. So I1 is 0. Into 1 minus tax rate minus preference dividend. First plan is 100% equity. So preference dividend is 0. E1 means what? Number of equity shares. What is the number of equity shares in plan A? 10,000. So denominator is 10,000. Okay, na Sarji. System is acting weird. This is the equation. Similarly, EBIT we don't know of second plan. That's what we are trying to find. Benchmark EBIT here. The rest all data you can take it from the previous table. Solve this equation. One quick way to solve is this 10,000 you can multiply to this. 5,000 you can multiply with this. That is one way. I don't like bigger numbers. What I will do is 10,000 divided by 5,000. 2. So directly 2. 10,000 divided by 5,000. How much? Directly 2. Now it's easy. Smaller number makes the calculations faster. This, but anyway, how to calculate is your call. So when you calculate, how much did you get? 16. That means what? The level benchmark for what? A and B. for benchmark for A and B is 16,000. 16,000. Got it? Everybody good? If project ka EBIT is exactly equal to 16,000, if project ka EBIT is exactly equal to 16,000, then either you can select plan A or you can select plan B. You will get the same EPS. Okay, na? If you want, I think I've proved it also over here, but any which way, I think now, time is not there. Leave. That's okay. Fine, now we'll agree with the theory there. Done now. What was one more theory, people? Like this, now we have, now we did a comparison between what and what? A and B. Next will be with B and C. Next will be with A and C. Okay. Now 1 minute, hang on. If you read the question, they asked, any plans dominate? Any plan dominate? Now people just observe. On debt, how much interest rate are you giving? 8%. On preference shares also, how much dividend are you giving? 8,000. Correct? Correct. Now, everybody, if you just observe, first, debt is there in which plan? Plan B. Preference shares is there in which plan? C. Now, when you calculate indifference point between B and C, when you calculate indifference point between B and C, what will happen is, check, I'll show you instead of telling. You will not be able to find out EBIT between B and C. Why? Sir, when you solve this equation, you will get this. You will get this on the left LHS. You will get this on the RHS. Left hand side, right hand side. This 0.5 EBIT, this 0.5 EBIT will get nullified. That means you will get negative 4,000 is equal to negative 8,000. EBIT you are getting, it is getting nullified. That's what they said. Sir, if you are not able to find out EBIT, that means one plan is dominating the other. Because indifference point means what, sir? Both are same. So there is not domination or no domination? No domination. But if you are not able to find out indifference point means, that means one is dominating the other. Which is that? You tell me, you know this. Sir, debt will dominate preference shares plan. No. Why? Though in this problem, interest you are paying at 8%, preference dividend you are paying at 8%, on debt you will get an extra advantage, which is what? Tax benefit. On preference shares plan, you don't get the tax benefit. That is the reason you are not be able to find an indifference point between these two plans. That is what you need to write. Debt plan will dominate preference shares plan because debt will get an extra benefit called tax benefit. Therefore, plan B will dominate plan C. You will not be able to solve. Just leave it here and write these comments. That is what they asked. Clear? Goindana Guruve, got it, Guruve. Got it. Take much, Mine, cheers. Over, and now, people, let's just for your assumption, just for your simplicity, 5 minutes, I'll quickly prove this. Sir, what was the indifference point between A and B? For A and B, when we solved indifference point, how much did we get? 16,000. So once again, theory, if project ka EBIT is exactly equal to 16,000, then either you can select A or you can select B. It will not make any difference. Both the plan ka EPS will be same. Because at indifference point, you can select any, both will give same EPS. Tell me two other scenarios here. If you are below indifference point, you will select that plan which uses higher equity because that will give you higher EPS. If you are above indifference point, then you will select that plan with a higher debt because that will give you higher EPS. Can we prove that? I proved it. Can I show it to you? Now, I'll not ask you. Last time I asked it in the batch show. They gave weird numbers. So here I only take. What is indifference point ka EBIT, people? Between A and B, 16,000. I've just noted it down here. IP as an indifference point. What is indifference point EBIT? 16,000. Now let's assume first case where actual EBIT, actual project ka EBIT is lower. It is not 16, it is lower. That means we are at above indifference point or below. So actual EBIT, let's say project ka EBIT is 10,000. Okay, na sir? Now stop. Which plan are we comparing? A and B. A is what sort of a plan? 100% equity. Plan B is 50% equity, 50% debt. As per theory, which one should you select? as per theory, if you are below indifference point, if actual project ka EB80 is lower than indifference point EB80, you will select that plan which is using higher equity. Here 100% equity, here 50% equity. Which is using higher equity? Plan A. Now calculate if you want. Now what is the EPS? How much is the actual EB80 I've assumed? 10,000. Now calculate EPS. Now I don't want to start with from the beginning. We'll use indifference point ka EPS formula. What is EPS formula? This. What is the actual project ka EB80 I've taken? 10,000. First plan is 100% equity. Will it have any interest? No. Into 1 minus tax rate. There's no preference dividend. How much is the number of equity shares? 10,000. How much EPS you got? 0.5. Any problem? Calculate for plan C. Same plan C. Plan B you calculate. How much is EB80? How much is EB80? Project ka EB80 is 10,000. Minus I1. Plan B has a debt. Yeah. Plan B has how much debt? 50% debt. How much is the value of debt? 1 lakh. And interest rate is 8%. That means interest rate is how much? 8,000. You calculate this for me. Let's see. Interest is 8,000. I'm only telling here. EB80 is 10,000. Okay. 10,000 minus interest is 8,000. Into 1 minus tax rate. Minus preference dividend not there. Number of equity shares is 5,000. Yes, no, G? Correct, no, G? Following, no? Or am I speaking to myself? No. How much did you get? 0.2. What is this? EPS. What did the theory say? If you are below indifference point. If you are below indifference point, select that plan which uses higher equity. Now, indifference point EB80 was 16. Actual project ka EB80, I assumed it to be only 10. So, you are below. So, as per theory, you have to select plan A because it is having higher equity. What did you get EPS of plan A? 0.5. Plan B ka 0.2, which is giving higher EPS. Plan A. So, theory is working out. Sometimes they also ask you to prove this by assuming various numbers. You can assume 15 or 14 or 10 or 3000. Any number you can assume and prove this. Such question also we have done in regular class. Just saying. Done now. Now, what do you think will be the next scenario? Now, this is below indifference point. Next will be higher. Now, give me one number above. We have to solve the whole thing again. We'll take this only. What is indifference point EB80 between A and B? 16. Now, I'll take one number above 16. I've assumed it to be how much? If actual project ka EB80 is 20, what will happen? Now, substitute. Instead of 10, now I'm taking it as 20. Rest all digits same. 20,000. Interest is not there in plan 1. Into 1 minus tax rate. Preference dividend not there. Divided by number of equity shares. How much are you getting? 1. Same thing, calculate EPS for plan B. EB80 is 20,000. Interest is 8,000. Into 1 minus tax rate. Preference dividend is not there. Number of equity shares is 5,000. How much are you getting? 1.2. 1 minute. Go back to theory. Now you are below indifference point or above. When you are above indifference point, you will select that plan which uses higher debt because that will lead to higher EPS. Now, this has 0% debt. This has 50% debt. Which is using more debt? Plan B. I mean, above indifference point, theory says you should select plan B because it gives higher EPS. Practically, did it work out? See, plan A ka EPS was 1. Plan B ka EPS was 1.2. So, obviously, you will have to select plan B. Goinda, got it. This is just a proving. You prove this in exam only if they've asked. Sometimes they do. We have 2 questions in our regular study material also, our class notes also. Check and do it. Otherwise, this is not required. And is it necessary to assume same number what I've assumed? No, you can take any number above indifference point, any number below. Take a little. If this is 16,000, don't take 16,100. Then you will get a close enough decimal. So then you will only freak out. So let there be some difference of 5 to 10,000. So it becomes easy for you to analyze. If this is 10, maybe take the other number as 18, 20,000 like that. First, just for easy purpose. Okay, sir. This is also done. No, done. Done. Okay, this one question I will tell you. One small concept is there. Because of that, I've taken this question. I'll read the question once for you. Arbitrage is still there. Chillo. Company needs 42 lakh rupees, 42 lakh 50,000 for new plant, new project. 3 plans are feasible. So 3 options. This 42 lakh 50,000 company may issue. First option what? 4 lakh 25,000 equity shares of 10 each. How much money? 42 lakh 50,000. So first plan is 100% equity. Second plan made 2,12,500 equity shares of 10 each and 21,250 debentures of 100 each. I mean, second plan is of 50% equity, 50% debt. Third, 2,12,500 equity shares of 10 each and 21,250, more importantly, cumulative preference shares. That's a crux. So third option is what? 50% equity, 50% preference shares. Luckily, Prabhu, they have only given EBIT. For how many years? 75, 1, 2, 3, 4, 5. Okay, sir. 5 years. EBIT is changing each year. That means we can have one column or 5 columns. 5 columns. Done now. Because they have only told each year ka EBIT is changing. You need to find out EPS. Faltu no. EBIT they have only given. They are asking EPS. How do you, to find EPS we need 2 numbers. What are those? Issue, number of equity shares, and they have given EBIT. Check, I've solved here. Take, or maybe I've assumed this all this as different cases, whatever, it's fine. No? Now, this is your EBIT given. From EBIT, reduce what? Reduce interest. Now, people, how many plans are there? 1 or 2 or 3? No? 1 plan or 3 plans? First plan is what? 100% equity. I'm not doing that. Second plan, 50% equity, 50% debt. I'm not doing that. Same, nothing new there. Third plan, I've solved it and put it up here because there's a small concept. I'm not solving this question. One concept is there. I just want to put it across to you. That was the intention of this question. So third plan, what is the third plan, people? 50% equity, 50% preference shares. And each year ka EPS same or different? Different. I've copy pasted this. This is your EBIT given. What sort of a plan is this again? 50% equity, 50% preference shares. So interest is there? No. You get PBT. From PBT, if you reduce tax, you will get PAT. Correct? For EPS calculation, we need PAT or ESH. How do you get ESH? Reduce preference dividend. Reduce preference dividend. 1 minute, everybody. Check the screen. How many preference shares are you issuing? 21,250. Each ka face value how much? 100. So what is the preference share capital? 21,25,000. Correct. So this is your preference share capital is 21,25,000. What is your preference dividend? Can you tell me that? What percentage preference shares are these? 8%. So basically preference dividend will be 21,25,000 ka 8%. How much, Guru? 1 lakh? 1,70,000. Any problem? 1,70,000. Now check the number. How much did you get it as profit after tax? PAT is how much? 45. But how much is the preference dividend you told? 1,70,000. Sir, PAT available is only 45. Preference dividend is 170. So one student will ask doubt. Sir, dividend we pay only when there is profit? No. Dividend we pay only when we pay profit. When we have sufficient profit. Here we have sufficient profit or shortage. Prabhu will write 45 and take 8 to be 0 and do it. You are right. Your thinking is right. That would be so when it is non-cumulative preference shares. When it is non-cumulative means what? Dividend will go on accumulating. That means can you escape? Meaning actually practically what happens is if you suffer a loss, if it is cumulative preference shares and if you suffer a loss, in the year of loss, company will not pay dividend. But in the next year when company makes profit, next year ka dividend as well as last year ka arrears of dividend, both will be settled. Yes, that means can you escape dividend payment in case of cumulative preference shares or you cannot escape? You can maybe escape this year, but in future years may you have to pay. Whatever dividend you did not pay previously, you also have to clear that dues also. Correct? Now, we are not doing accounting. We are doing analysis. Subject is not financial accounting. It's financial management. So, from our decision making is concerned, can you escape preference dividend ka payment or you cannot? That means don't write 45 or don't write 0. What is the preference dividend amount? 170. Take that as it is. Okay, people. That means your ESH will be positive or negative? Negative. No problem. Sir, EPS it is. What is it? EPS. We have done an accounting standard 20 in case you remember. Or leave that. I'll not go there. Now, EPS. EPS is what? Earnings per share. They did not say profit per share. It is earnings per share. Earnings can be profit, earnings can be loss also. It doesn't matter. If you get each negative, your EPS also will be negative. Go ahead and calculate. EPS can also be negative. Absolutely no problem because it is earnings. Earnings can be positive or earnings can be negative. Earnings can be profit or earnings can be loss. Doesn't matter. But deduct full preference dividend in all the cases. That too was the small concept in this problem. That's all. First two case mein this drama is not there. It is very simple. Only in this case mein, this is one concept I wanted to put it across. Rota, final, pakadana. And now an arbitrage quickly we will review. Correct. See, they are also explaining now. All election wala drama, I think, no? All of you have voting eligibility, yeah? So obviously goes without saying you will vote. Awesome. Now 1 minute. Arbitrage. Sir, there are 4 cases of arbitrage. I'll explain one as one problem and remaining I'll just quickly tell you what needs to be done. Now, first of all, you tell me what is arbitrage or when will arbitrage come? First of all, arbitrage is as per whose model? You're keeping what as a base? approach. As per approach, if there is no tax rate, levered firm ka, unlevered firm ka, both ka value should be same. If it is not same, then only you can do something called arbitrage. And this arbitrage is an activity not done by the company, but by the investor. Okay, sir? Alright, how to do it? Very simple. First, I will go through the question with you now. One question we will take. There are 2 companies, N and M. Keep your calculator, nothing to write down anything. Just observe, that's it. 2 companies, M and N. They are having same EBIT. How much is that? 20,000. Both the firms ka EBIT is same. M is a levered company having a debt of 1 lakh. At what interest rate? 7%. Cost of equity of N is 10, M is 11.5. Cost of equity given. Now people, arbitrage only works when value of both the firms is not equal. Yes, no? So first let's confirm that. So first step in arbitrage problem is to find out market value of both the firms. Here one is a levered and one is a unlevered. What is levered? M, because they are using debt. So that means N becomes your unlevered. Find out the market value of the firm. How do you find out market value of the firm? EBIT by KO. Have they given KO or have they given cost of equity? Cost of equity. Yes, sir. That means you can find out KO directly? No. There is another formula to find out value of the firm. What is that? S plus D. Do you know the value of debt? Yeah, how much? 1 lakh. That means you just need to find out S. And how do you get S? Net income divided by cost of equity. Sir, net income is nothing but Ish, no? They have given EBIT. From EBIT, can't you find out Ish? Yeah. Cost of equity, they have only given. That means first work out what? S. So check what I've done here. Started with EBIT. How much is EBIT for both the firm? 20,000. M is a levered. How much debt are they taking? 1 lakh. At what rate? 7%. M has an interest rate of 7,000. N is unlevered. So interest will be 0. So you will get earnings before tax. Since this whole concept of arbitrage works when there is no tax rate, where value is same. So your earnings before tax, earnings after tax and net income all are same. How much is that? 13,000. Till here, anybody, any doubt? No? Paka? Yes. Now to find out S, we need one more component, which is what? Cost of equity. Is cost of equity missing or given? How much was that? For careful, for M it is 11.5, N it is 10. First we wrote M, no? For M it is 11.5%, N it is 10%. So these two if you divide, what are you going to get? 13,000 divided by cost of equity if you do, you'll get S. What is S? 113043. These two ka division will give you 2 lakh. Done now. But we need S or we need market value of the firm. How do you get that? S plus D. Levered firm is using how much debt? 1. Debt usually book value, market value will be same. If they don't say, because debts are usually not traded. Even if it trades close to the book value. Hence the conventional assumption is book value and market value both are same. For what? Debt. What is book value? 1 lakh. So market value also will be 1 lakh. This firm is an unlevered firm. So their debt will be 0. Now you got the value of the firm. Okay, na sir. There, keep in mind, there is no tax rate. There is no tax rate. This is levered firm. This is unlevered firm. If there is no tax rate, both this firm ka value should be same. Is it same? No. Now only you can think about doing something called arbitrage. This is the first step in arbitrage, finding the value of the firm. Easy. Everybody good? Arbitrage company does or investor does? Investor does. Now check here. Compute how the arbitrage works. Assume investor owns 10% shares in the levered company. Currently, investor is holding shares in which company? Levered company. Sir, arbitrage is a very simple process. What it is whichever firm ka shares is overvalued, whichever company ka shares are overvalued, sell it and buy whichever company ka shares which is undervalued. Once again, what is it? Whichever firm's ka shares is overvalued, sell it and buy that shares which is undervalued. Now check here, which firm ka value is overvalued? First is what now? M. M is overvalued because its value is more and N is undervalued. Now people, you tell me what will happen, or arbitrage ka if you want one more synopsis. Now, or tell me what will happen here as an arbitrage process. This particular M limited ka shares people will sell and buy what company ka shares? N. Agreed? Why? Whichever firm is overvalued you will sell and whichever firm is undervalued you will buy. That's a simple shifting process in arbitrage. Yes. Now think, it's a simple economics concept. If more and more people sell M ka shares, what will happen? If the demand, if the supply is more than demand, what will happen? Price will fall. So if more and more people start selling M ka shares, means M ka value will go on reducing. Whose firm ka shares they are buying? N ka. So if more and more people buy N ka shares, N ka value will increase. At some point of time, both their value will become same. Till that time, you can do arbitrage. Till that time, this value becomes same. You will go on doing the arbitrage. Who? Company or investors? Yes, that's the meaning. Not required for your exam, just for your knowledge sake. Clear? Done. Now, you tell me again, investor is currently holding shares in which company? Levered firm, which is M. How much percentage? 10%. Keep your calculator. Everybody. An investor is holding shares in which firm? M company, levered firm. Okay. And now he wants to sell it. Now you will sell it at book value or market value? What you will sell? Equity shares. This is equity shares ka market value or firm ka? What is equity shares ka market value? 113043. This 113043 is market value of one share or 100%? 100%. Investor is owning 100% or 10%? So calculate. That means by selling, investors will get how much money? 113043 ka 10%. That is your market value of this. By selling the share, investor will get how much money? 11,304. Clear? Done, people? And now arbitrage, you can do in two approaches. One is surplus cash approach. Another one is surplus earnings approach. Surplus cash, surplus earnings. So here first I am showing you surplus cash approach. Okay. In surplus cash approach, what it works is, first, can you tell me what currently investors are a shareholder in which firm? M Limited. Can you tell me this shareholders ka return? This shareholder ka return. Shareholders will get share in EBIT or EISH? EISH. What is the EISH of the levered firm? 13,000. Right? An investor is owning 100% or 10%. So what is existing return? Remember the first problem we did 2,800 ka 2% something? Same. EISH here is 13,000. Investor is owning 10%. What is existing return? 13,000 into 10%, which is 1,300. That is the next step. First step, again, walk me through what is that? Finding out market value of both the firms. Second step, it's not mandatory to present in this firms only, okay? But all the four problems I have presented in this firm so that it becomes a template or format for you. Becomes easy to solve, okay? So first step is to find out market value of the firm. Which firms? Both the firms. Second, by selling the shares, how much money you will get? That's the second step. Third one, you find out the existing return. How do you find existing return? Take the EISH and multiply shareholding percentage. Okay, sir. Comfortable? Now in surplus, this which arbitrage are we doing? Surplus which approach? Cash approach. In surplus cash approach, if your existing return is 1,300, listen to this carefully. If your existing return is 1,300. When you shift over to which firm? Now you are going from levered to unlevered firm. Even when you shift from levered to unlevered firm, your returns should still be how much? 1,300. There will not be any change in your earnings. Because you are not using surplus earnings approach, you are doing what approach? Surplus cash approach. That means if your existing return is 1,300, even after shifting, your return should be 1,300 only. That's your checkpoint. If you don't get it, you have done something wrong. There only you have the answer. Fine, now I'll prove it to you. Anyway, we can review that. Done. Now people, in arbitrage process, no, you're doing arbitrage to get some gain. You're doing arbitrage to get some gain. But risk level should not change. Risk level should not change. Now everybody observe, investor is a shareholder in which company? M Limited. M is a levered firm. Levered firm means it has a debt. A firm using debt only we call it as levered firm. Now careful. Levered firm is using debt means levered firm has an element of risk. What risk? Debt risk. And currently we are an equity shareholder in the levered firm. That means we are also exposed to debt risk. Do you agree with me? If a company is exposed to debt risk means since we are the investor in the company, we as an investor also are exposed to debt risk. Agreed? Yes. How much debt levered firm has taken? 1 lakh. Right? Will I be, as an investor, will I be exposed to 100% of the debt risk or my shareholding percentage? M Limited has a total debt of 1 lakh, but my exposure to debt risk is 1 lakh or my share percentage? How much is that? 10,000. Correct? Now that means I have a debt risk to the extent of 10,000. Do you agree? Now I am selling M ka share and buying which company ka? N. N is unlevered firm. Unlevered firm means they have debt or no debt? Means risk reduced. Risk reduced. In arbitrage process, risk level should be reduced or risk should be maintained. Risk should be maintained. But this firm does not have any debt. Here M Limited, since they had a debt, as an investor, I had one risk on my head. What risk I had on my head? Debt risk. Debt risk. Now I have when I shift over to N Limited, I have debt risk on my head or no debt risk? Can I change the risk or I should maintain? Hence, to maintain the risk, what investor will do here is borrow. What investor will do is borrow. Take a loan. How much? 1 lakh. Here, investor had 1 lakh ka debt risk or shareholding percentage? 1 lakh ka 10%. How much is that? 10,000. That means here, investor will borrow how much amount? 10,000 rupees. Why do we do this borrowing? Because the moment you borrow, investor is taking a debt. That means investor will have a debt risk. Earlier also investor had a debt risk. Now also investor has a debt risk. Because risk should not be changed due to arbitrage process. Done now people. Once again walk me through. This is the most important step. Walk me through this process. What is this? Currently investor was a shareholder in which company? M Limited. M is a levered firm. Levered firm means it has debt. And I was an investor in this firm means as an investor I also had a debt risk. How much debt firm had? 1 lakh. That means I will be exposed to 1 lakh ka debt risk or my shareholding percentage. What was my shareholding percentage? 10%. So what is 1 lakh ka 10%? 10. So before this I had a debt risk of 10,000. Now can I reduce this risk or maintain? How do I maintain this? By taking a borrowing. How much amount? 10,000. Clear, sir? Any problem, sir? No. Now people, investor totally has how much money? Can you tell me? Investor totally has how much money? Investor borrowed how much? 10,000. He also sold M Limited ka share for how much value? 11,304. By selling levered firm ka shares, investor recovers 11,304. By taking a loan, how much investor got? 10,000. So total cash available how much? That is the cash available for investment. Agreed? Any problem? No. Now we'll use this money for what, Joy? To buy the shares of the other firm. What is the other firm? N Limited. Yes. Now 1 second, hang on. Surplus earnings approach or surplus cash approach? Surplus cash approach. In surplus cash approach, what will happen is, how much is investor holding previously? 10%. In which firm? M Limited. Now also investor will hold how much? 10%. But of N Limited. That means shareholding percentage in surplus cash approach will change or it will not change? If investor was holding 10% here means now also he will continue to hold how much? 10%. Correct? So investor will buy how much percentage equity shares in Unlimited now? 10%. Okay. Now people, what is the market value of equity of the unlevered firm is 2 lakh. This 2 lakh is for 1%, 10% or the whole company? Whole company means it is for 100%. Is investor buying 100% equity or 10%? So how much money we need? To buy 100% we need 2 lakh. For 10% how much we need? 2 lakh ka 10%. How much is that? 20,000. Oh, happy news. Why? Sir, investor has how much cash? 21,304. But cash needed for investment is only 20,000. That means, is investor utilizing the entire cash or some extra cash is still pending? How much is that extra cash pending? Camera. I thought I'll capture you beautiful people. Where it went? Here. Now, how much cash investor is still left with? 1,304. How? 21,304 is available, but utilized is only 20. How much is pending? 130. This is the gain investor got. Through what process? Arbitrage process. Now, investor can do whatever the hell he wants with this extra cash. Throw it, tear it, use it, whatever. That is your surplus cash approach ka arbitrage. Understood? Yes. Now, one more checkpoint should be satisfied. What is that? In surplus cash approach, if your existing return is 1,300, after shifting over to the other firm, also your return should be 1,300. If it changes, you have done arbitrage process, something wrong. Can we test? Now investor has shifted from what firm to what firm? M to N. Shareholding percentage changed or same? Same. What is the return for equity shareholder? EB80 or based on EASH? Now shareholder is shareholder in M or N? N. What is N ka EASH? 20,000. How much percentage shareholder investor owns? 10%. So what is the return? 2,000. Ayyo, wrong no. You told some value wrong. Don't do like this. Marathon, no camera and all is recording. What are you doing? 20,000 into 10%. What is the return? 2,000. Correct? No. Sir, how much was our existing return? 1,300 and it became 2,000. I mean, somewhere we have done wrong. Not wrong. Correct only. Correct only. Return, how much did you get? 2,000. But in order to do this arbitrage process, investor also took a borrowing. On borrowing, if you take a borrowing, you will receive interest or pay interest. Interest is at what rate? 7%. How much loan investor took? 10,000. How much interest investor has to pay? 7%. So how much interest will go off? 7. Return is 2,000. Interest payment is 700. Net number is how much? One is a benefit, another one is a cost. So net benefit how much? 1,300. Earlier how much it was? Changed as same. That means arbitrage process done and dusted. Okay, na sir. This is what approach? Surplus cash approach. See, I have written the synopsis over here. First case, you are shifting from levered to unlevered firm. Which case mein? Surplus cash approach. In surplus cash approach mein, shareholding percentage will change or same? Earlier, if you are holding 10% means now also 10%. Will return change or same return? Same. Okay, na sir. Now next case, same. You are going from, or 1 minute. I'll give you some 1 or 2 minutes to process this. Observe. Many people skip arbitrage. It comes people. Okay, it's also one of the important concepts. Can we give a quick walkthrough of this? Again, run through. What is the first step? Tell me in steps now. Let's see if we can recollect. Arbitrage process, when will it come first of all? If there is no tax rate. If there is no tax rate, levered and unlevered firm ka value should be same. If it is not same, then only you can do something called arbitrage. That is the first step. Arbitrage ka simple process is whichever firm is overvalued, sell it. And whichever firm is undervalued, buy it. Okay. First step in arbitrage process is to find out whether both the firms ka value is same or not same. Hence, first you need to find out V as in value of the firm. Two firms, levered and unlevered firm. First step. Clear? Second, now investor will sell the shares. Investors will sell the shares at book value or market value. So take the market. Here we are going from what? We are shifting to what to what? Levered to unlevered. What is market value of the levered firm ka shares? 1,13,043. This is for 100%. Will investor own 100% or 10%? So by selling the shares, how much money investor will recover? 10%, 11,304. And through this, since it's surplus cash approach, return should change or same return? Same return. So first find out what is the existing return. For an investor, how do you calculate existing return? Based on EBIT or EASH? So if you want it as formula, what will be? EASH multiplied by shareholding percentage. Currently, a shareholder is in M Limited. What is M Limited ka EASH? 13,000. What percentage shares are we owning? 10%. So 13,000 ka 10%. How much? 1,300. This is our existing return. Even after arbitrage, the number should be same. Now, currently we are a shareholder in which company? Levered firm. Levered firm has a debt. If levered firm has a debt, as an investor, we also have a debt risk on our head. How much debt levered firm has? 1 lakh. Full 1 lakh we have debt risk or our shareholding percentage. So how much is that? 10,000. Yes. So due to arbitrage process, risk level can you change or keep it? Keep it same. But how do you keep it same? Because unlevered firm does not have debt. So what to do? Borrow. How much money? 10,000. That you will borrow. That means you will get two sources of finance here. You will get cash from two sources. What is that? One borrowing, another by selling levered firm ka shares. Both if you add, you will get the total amount available for investment. How much is that? 21,304. But in the surplus cash approach, will the shareholding percentage change? No. Here you are holding 10% means here in this firm also you will still hold 10%. Okay. But to buy 10% in unlevered firm, how much money you need? What is the market value of equity in the unlevered firm? 2 lakh. Are you buying 100% or 10%? That means how much money you need? 2 lakh ka 10%. How much is that? 20,000. You need 20, but you have how much? 21,304. So how much money you are still left with? 1,304. That is a gain due to arbitrage. 1,304. Okay. But earnings should change or same? Same. How do you find out earnings for equity shareholder now? Now we are a shareholder in N Limited. How do you find earnings? Based on EBIT or EASH? EASH. What is the EASH for N Limited? 20,000. This 20,000 is for 100%. We own 100% or 10%. So what is our return? 2,000. This is one return. But we also borrowed. How much money we borrowed? 10,000. On this borrowing, since we have taken a loan, we need to pay interest. At what rate? 7%. So 10,000 ka 7% interest is a payment. This is a return, this is a cost. So what is the net return? 1,300. So earlier also it was 1,300. Now also it is 1,300. So any change in return or zero? That's all. That's your arbitrage process done through which angle? Surplus cash approach. Now the same scenario, if you have understood this, same scenario, we are going from levered to unlevered firm. Not under surplus cash approach, but under surplus earnings approach. Surplus earn. Sir, in surplus earning approach means if you are already getting 1,300, we will expect 1,300 or more. That's the second approach. If you want to get more means, will you buy same 10% or you will buy whatever amount? So if you are doing here, if you're going from levered to unlevered firm under surplus return or surplus earnings approach, simple thing is how much money is available for investment now? 21,300. This, any part of this money you will keep it or you will invest this fully? Invest this fully. Invest the entire amount available. That's what I've written over here. So in this problem, what was the amount available? 21,304. Entire 21,304 you will invest. Clear, sir? That's the only thing. That means your shareholding percentage will be same or change? Change. How much? Sir, to buy 100% of N Limited, how much money you need? 2 lakh. Are you investing 2 lakh or 21,304? So with the 21,304, how much shares can you buy? To buy 100%, we need 2 lakh. It's like this Dabba approach. If you want to buy 100%, you need how much money? 2 lakh. But are you investing 2 lakh or 21,304? With 21,304, how much is the shareholding percentage? Calculate. So basically 21,304 divided by 2 lakh into 100. How much? 10.65%. Earlier you were holding only 10. Now we are holding 10.65. So if you are owning more means your earnings will be same or earnings will be more. Again calculate the earnings. Earnings in the old firm or new firm? New firm. But new firm ka earning will be same. Existing firm ka earning is 1,300 means new firm ka earnings will not be 1,300. It will be more. That's your checkpoint. If you get more, you have done. You have done right. Otherwise, something wrong. That's all is levered to unlevered from under which approach? Surplus earnings approach, a surplus return approach. Clear, sir? This is movement from what to what? Levered to unlevered. Now, what do you think in the next case will be? Unlevered firm to levered firm under first surplus cash approach. Fourth case will be unlevered to levered firm under surplus earnings. Clear? Now, tell me this, from what to what you are moving? Unlevered firm ka shares you are selling, levered firm ka shares you are buying. First step same, second step same, third step same. What is first step? Finding value of both the firms, same. Whichever is the case, first step, every case same. Second, you are selling, you are selling means you will sell it at book value or market value. So find out by selling how much money investors will get. Second step. Third one, find out existing return. Now you are a shareholder in which firm? Unlevered firm. Find out the existing return in unlevered firm. Done now, people. Now 1 minute, hang on. You are a shareholder in which firm? Unlevered firm. Unlevered firm means debt is there or debt is not there. That means as an investor, you have debt risk here or don't have. But now you are shifting to levered firm. Levered firm has a debt. That means one extra risk came called debt. Risk level should change. Risk level should be same. Earlier, we did not have debt exposure. Now we are exposed to debt. That means now we are getting extra risk. In arbitrage process, risk level should be changed or maintained. Maintained. Now we can't tell the levered firm as an investor, you repay your debt. I don't want that risk. You can't do that because you are a small chintu pintu investor. So now you can't dictate terms, correct? But we can't change the risk also. Now you will borrow. You will borrow. Hey, you already did not have debt risk. Okay, you don't have debt risk. So is borrowing required or not required? Not required. But since you are exposed to debt risk, what we will do here is you will have money to invest. No, you will have money to invest. Don't buy just the equity shares of the levered firm. Also invest in debt to cover that risk. Because when you invest in debt, you get a fixed return. You get a fixed return. On equity, you don't get fixed return. So that way, the risk level will get balanced. Understood? Once more, Govinda. What does it tell me? Use this. Tell. If you're going from unlevered firm to levered firm, under which approach? Surplus cash approach. What are we doing here? In unlevered firm, we did not have debt risk. But since we shifted to levered firm, we are now exposed to debt risk. But risk level should not change. Hence, what do we do? Whatever amount you have to invest, right? You invest, you use that money not only to buy equity shares of the levered firm, but also to buy the debt. How much debt? Very simple. What is your shareholding percentage? 10%. So invest in that shareholding percentage. Suppose levered firm has 1 lakh debt. Levered firm has 1 lakh debt. You will buy full 1 lakh or your shares? Your shareholding percentage, 1 lakh or 10%. Got it? But do keep in mind, this is still which approach? Surplus cash. So that means you will invest some portion of your money in equity, some portion of the money in debt. But will your equity ka shareholding percentage change or same? Because which approach? Surplus cash approach. That means your return should change. No change in return. No change in return. When you compare amount available for investment with amount invested, you will have some balancing figure. That balancing figure only is your surplus cash. Same drama, but the only step is you will not invest just in equity shares, but you will also invest in debt. How much debt? Your shareholding percentage. Take the debt of the levered firm and multiply your shareholding percentage. That much you will invest in debt. Correct, people? Got this? If you have got this, tell me the next approach. What is the next approach? Unlevered firm to levered firm. Which approach? Surplus earnings approach. First step, same. What is first step? Value of both the firms, same. Second step. By selling the shares in unlevered firm, how much money you're going to get? Second step. Third one, existing return. Same. Fourth one, investment. Now again tell me, we are a shareholder in which firm? Unlevered firm. We have debt risk or no debt risk? Now we are shifting to which firm? Levered firm. But levered firm has debt. That means we automatically got exposed to debt risk. How do we cover? Invest in only equity or also debt? But hang on, surplus earnings approach. That means we want to earn same or earn more. If you want to earn more means will we keep any cash idle or invest fully? Invest fully in both equity and debt. In what ratio? Debt equity ratio. In debt equity ratio. And usually this debt equity ratio will be 1:1. most of the problem here, they'll keep it same. That means equal amount you'll invest in debt also, equal amount you'll invest in equity also. That means since it's a surplus earnings approach, you're buying same 10% equity shares, or you don't mind buying more. In fact, you want to buy more. Correct? No, that means your shareholding percentage will be same, or it will change. Change. Your earnings will be same, or earnings also will increase. Earnings will increase. If you compare existing earnings with new earnings will be more. That only becomes your arbitrage ka gain. Okay, people, keep this pointers as a base and try to solve those questions, because I don't have time to cover all the 4 questions. That will be taking another 45 minutes to 1 hour. So quite difficult in the interest of time. But I hope this is okay with you. We have done it in regular class, by the way. Don't spread rumors. He missed anta. Regular class we have done. Here it's difficult. Photo take macha. Cheers. Which one you want? You want me to zoom in? Okay, I'll keep it here. Nanna. Is this okay? Super. People, congratulations with this capital structure is officially done. Thank you.